Very good morning to all the members, to everyone who is present in this webinar. The webinar is being organized by the Committee on Financial Market and Investor Protection, that is ICAI's committee. We have the presence of Mr. Milind Upasani with us, who is considered as the mentor for the share market. He is having the expertise in this subject for many years. First of all, I would like to introduce with the topic that the topic is from books to booking profits. The CAs are considered as the experts in knowing the finance of any company. But since then, we now, in order to become the CAs from CAs, we need to have some updations in our knowledge. Like we need to become the chart analyst from being the chartered accountants. And for that matter, we have the mentor that is named as Melindu Pasani sir with us. If we are having the expertise in understanding the microeconomics and microeconomics of any of the economy, we will be ensuring the wealth creation and the better wealth management of our clients in every single matter that we give. And investment portfolio is one of the matters that can take India further to become the largest economy in the world. And we, as chartered accountants, have a greater role to play not only in the creation of the wealth of our society, but the wealth of the country at large. Now, I would like to welcome Mr. Milindu Pasani, sir, who is going to conduct this session. Sir, all over to you.
Hello and a very good evening, everybody. I feel really honored and humbled to be on this platform. By profession and qualification, I am an engineer. It is really great to see that a society which is built up of all the financial experts are open to listen from me. That's really an overwhelming
Our
experience
honor,
for me.
sir.
Thank you very much. Can I continue, or how is the plan from here?
Yes, sir. We can continue your presentations regarding the topic.
Okay, that's wonderful. So again, a very good evening to everybody over here. This is a great engaging opportunity, and I'm very thankful to all of you to taking time out so near to a beginning of a new year. I would not call it end of 2023, a beginning of a new year. And I would like to take this opportunity to really come up with a concept that as a self-learner also, we can do well in the market. There's a lot that we can get from the books. And to support that, I'm going to just take through the books that I went through, how I inferenced through it, how I learned through it, and how did I build my strategies from there onwards. So this is a complete initiative where I want to take you along the journey I had so that you also start believing that you can do it, right? Okay. So I'll first move on to the presentation from here onwards. The idea of questioning over here is that I am covering around 4 books, and fifth session will be the live case studies. So at the point of every particular book, I'm going to take a pause after I completed the concepts. Then you can put up your queries, which then I'll respond over there. In case I see certain queries are just stretching us beyond the time limit, I'm sorry, I'll have to just take a time out and move on to the next topic. My apologies for that right in the advance. Okay, so let's begin the journey. Right. So from books to booking profits, this is a very passionate topic towards me because every morning or every other week, I kind of remember these books which have changed my life for better. And to get you motivated on this journey, let me quote you something which has come from the great master of mine, that is William O'Neill. So this is a reminder that comes from William O'Neill. I'll just read it for you. Don't ever let anyone tell you it can't be done. You can learn to invest wisely as long as you are willing to study all of your mistakes, learn from them, and write new self correcting rules. This can be the greatest opportunity of a lifetime if you are determined, not easily discouraged, and willing to work hard and prepare yourself. Anyone can make it happen. So, this is the belief that I want to bring it up in you, as well as maybe transfer that energy that I have towards you so that you can also start treading this path. Because as a retailer, as a small time investor or a trader, we think that we cannot do much in the market. But believe me, we can be smart, we can pick up on what the biggies are doing and then play around with it. That is what is the main philosophy that you will see as we go from one book to another. For the formality's sake, I want to make it very clear that I'm not a SEBI registered advisor. What I'm discussing in this video is creating awareness towards investing. Nothing is that is shared in this discussion is to be considered as an investment advice. That said, I'm making best of my efforts that I can give you the best of the best opportunities which are available in the market currently as a test cases. You can live through them and get a confidence that, yeah, this system works, these processes work. Okay. The journey path from here onwards for the next, I would say, 2.5 hours or 3 hours would be around what has been my early days in the markets, then the four gurus and their mantras which changed my life. I'll be summarizing their key interpretation after every particular book. What did I pick from there? Okay. And then in the end, I will try to bring how do can we build a strategy from what these books gave me. Okay. That is from mantra to tantra. Mantra is the knowledge that you have got. Tantra is the technique now that you develop out of it. We'll be looking at certain case studies and I'll be sharing my further connection references so that I can always join your journey whenever you prefer, you think it is good to work together. Okay. Now these are my early days and many of you people would feel it is very much similar to the journey you have been having. So yeah, the first thing first when we come into the market is that we get a sense of randomness over here. Lot of us are brought up with the thought that market is a lottery, kismat ki baat hai, it is a gamble. It can work out for you, it may not work out for you, and then there are all blazing channels around us. In my early days, it was just TV channels. Now you have YouTubes, you have Twitter, you have Insta. Lot of noise, lot of noise. Everybody looks like an expert to us. When a stock goes up, we look and backtrack who all mentioned about it, and we start feeling that these guys are experts. We start working with what they say, and then things start falling off. Then things start falling off, and we really get lost in the market. And then what we observe is that we do not have any tracking model, we do not have any trading plan, and absolutely we do not have any process. Why process is important in the market? Because market is a game of probabilities. And how do you beat probabilities? By building a process. Because if you keep hitting at one place on the wood, one day it is going to crack, right? But if you're going to hit it randomly, one day here, another day here, another day here, the probability of cracking that wood is going to be very, very less. So the first thing first that I understood in the market is that I need to have process. And when it came to process, then there was another chaos. There were a lot of approaches to choose from. Somebody selling, let's go fundamental. Somebody says, let's go technical. Someone says, let's go long term. Someone says, let's go short term. Someone starts with a short term. And when it fails, says, let's go long term. So all these kind of things really start happening around me. And that also confused me. So I need a process, but I don't know which way to go. There are a lot of approaches. You have swing trading, you have trend following, you have bottom fishing, you have value investing, you have contra, all sorts of things around you. So again, it started making me nervous that what is it that I'm going to really choose from them. And then there was this psychological roller coaster. I'll just take you back to 2016. I got quite a good lump sum amount from one of my real estate sell-off. Now, what I did for the safety sake, I put it in a debt instrument, thinking that market is high, it might correct. But from 2016 to 2018, it really went very well. And then came the regret that, oh, I'm missing this bus. So I started in 2018. And then what happened? The correction came. That's another thing that frustrated me that, this is turning out to be really a roller coaster for me. I'm just not able to figure out bloody how I'm going to tie down this animal, how I'm going to figure out that, there is some definition to it, bringing into shape, build some process around it. So that urge, whenever you lose money, it motivates you to figure out, let's crack this problem. How am going to crack this problem? So that is where somewhere I was very fortunate to get my first book. And what was my first book? I'm keeping physical samples here so that you believe what I'm saying over here. So this was my wonderful first book. So if anybody has not initiated in the market, I would suggest always ask them to go through this book. Why this book? This book is by Stan Weinstein, Secrets for Profiting from Bulls and Bear Market. Why this book? Because it very smoothly lands you into technical analysis. The big problem, what I find why people do not get comfortable with technical analysis is they start with candlesticks patterns. You have the engulfing, you have the bullish engulfing, you have the bearish engulfing, you have morning star, you have evening star, you have dojis, you have Marabozu. All these things actually scare you down. That is where I felt that this book was beautiful because it did not really start at that depth. It really started at a higher level. And from there, it made me comfortable with technical analysis. And in between, it spreads a bit of message around fundamental analysis. So that was the mix from where I started with this book. Now, let me take you through what are the salient points that you would see in this particular book. My approach here will be first, we will talk about a kind of a summary, what this book speaks about. Then I'll pick out the thing that really matters out of my experience coming out of that particular book. Okay.
Definitely, sir. But I would like to interrupt my audience over one point that sir, who is talking to us and giving his precious time, is sir is engaged with many of his years to make these things learned to us. Sir has started his career with Tata Motors and then transitioned into SAP ERP developer analyst role in 2000. While continuing to work in IT sector, he started investing into equities as a side hustle. After seeing randomness in returns, he developed a structured approach to the markets, that is, using the techno funda rules based strategies. Returns become predictable, my dear friends, to a much larger extent by using his strategy, which is the combination of technical analysis as well as the fundamental analysis. His enriching career is the spanning of 25 years in IT and manufacturing industry, being immensely passionate about enabling others to financial freedom. He is currently active in social media platforms and has been conducting many seminars. It's our good luck, it's our valuable time that sir is giving to us. Sir, thank you so much for enriching us with the book that you have currently presented. I think my audience will get benefited by reading that book. Thank you so much, sir.
Thank you, Tanu. I know when you were speaking, it was like I'm hearing about my past life.
Definitely, sir.
Getting into the market got me so involved that I don't even think that I did that in this life. That's how the market are. They're so interesting every day,
But we
right?
would like to have some lines about how your career transitioned into this market, like from being mechanical engineer into share market. It's totally different field. How it happened?
It happened because of a kind of a childhood plan that I had in my mind that you should distribute your life into 24 years brackets. Okay, 24, then you have 48, then you have 72, and by God's grace, you go further. So, my plan for 24 years was to develop skills, just developed skills. That's all that you have to do in this age, and that is what I did. Okay. I am a big fan of statistics and mathematics, not a big scorer, but I love going through it. So that is what has helped me in the markets also. Then from 24 to 48 age, this is the place where I wanted to just serve the industry. I would never call you should do a job. You should serve the industry. Because when you serve the industry, your mindset is different. Your mindset is problem solving. Your mindset is helping and enabling people. And that keeps you motivated. The day you start looking at your job, your profession as just a money earning machine to survive in your life, you will stop thriving. So that is where I took an attitude that for next 24 years, I'm going to serve the industry. And from there onwards, 48 to 72, my plan was to just build people. Just build people into what? That was not clear to me, but by God's grace, as I moved through my uh, professional career, I figured out that we can ease out a lot of people's life in this world by help them making some good amount of extra money, taking them towards being rich, taking them towards becoming wealthy. What happens when you are wealthy? The best thing that happens to your wealthy when you become wealthy is that you start living the life you want. You start living the life you would like to live. You start living life with your own choices. So I don't believe that you should have a wealth to buy a BMW and a Mercedes and show it off anywhere. That's really small. In front of that, what do we really want is that I can spend my time the way I want with the people whom I like and the way I can contribute towards the society and towards others, even in this part of the story. So that is where I am in journey from 48 to 72. When I really became full time in 2020, I am exactly 48. So that was the God's grace. So now from here onwards, yes, next 24 years is for the people, build them up into some or the other skill. For now, definitely it is equity markets. By God's grace, if something else comes up, I would love to keep on contributing. So as a whole, my focus has been to contribute towards the people around us, and that is has been a motivation. And somewhere down the line, through my personal interest in market and in mathematics and statistics, that is where I started delving in market in more details and arrived at this particular spot. So one thing I'll definitely tell you: don't think to use market as a runaway guide from your profession or from your job. Never do that, because if you are running away from something, hard chances that you would succeed. Instead, use market as an alternative source of income and then start driving that income to have more freedom in the choices you make in choosing your profession. Stay professionally involved all time. That is what I would recommend. Yep. I'm sorry, at times I get preachy, but that's what is coming out of my heart. Thank you.
Definitely, sir. Definitely, definitely. I think my audience will definitely take this noted that one should be into his or her profession, and this can be an enhancing tool to be served to their clients.
Absolutely. Right. So
Yes,
now
sir.
let's move on. We are good.
Yes,
Yeah.
sir.
Now let's move on to the first book, my first guru, that is Stan Weinstein. So I would really not spend time around the authors because you can always Google about them. Let's talk about what they talk in this particular book. So this book, the biggest influence this book made me was to understand that you have to be a friend with the trend. Friend with the trend is absolutely important. Okay. And everybody talks about it, right? Friend with the trend. But the problem is, if you join the trend late, you are at risk. So what tell over here is that friend with the trend early in the trend. We should become also early in the trend. Now, how can we become early in the trend? If we are able to track the change in the trend, understand step by step how we are moving, change in the trend. So this is the sweetest spot that this book introduced me to. That if you really want to make good money in the market, number one, ensure that you are with the trend. You are not going against the trend. Number two, ensure that you are early in the trend. Like today, the market is in uptrend, right? But is it the safe market what it was on the 1st of April 2023? No, it wasn't. It was absolutely on the 29th March that we started an uptrend. And if you have been in the market from that point onwards, yes, you would make good money. But if you join in today, you are at risk. So that is a very good concept that came out of this book. Now let's look at the major summarized points that this book tells you. It tells you that market major trends are critical for successful trading. We have to ride the wave. We cannot go against the wave and make money. That will literally wash us off. Okay. So I am a turtle. I go with the trend. I don't swim against the trend. That is very, very clear. Then remember that stock prices move in cycles. This is absolutely very, very important. Why understanding this that stock prices move in cycles is because that takes away that sense of greed and fear out of you. Greed comes when the stock market is running high. But if you know, जो ऊपर गया है, whatever has gone up is going to correct and come back, you would learn to be patient. You would learn to be patient. Let it run. When it cools off, I will start my ride. So that is what is that, because stock prices move in cycle, and whatever comes down, it is going to go up. Now, this is something where you should not fall in the trap. This thought that whatever comes down is going to go up is to be avoided. That is a big trap, because not everything that goes down comes up. Many times you'll observe what comes down versus what goes up are typically different, at least within 2 3 years. So typically the whole line, whole downtrend to finish, build up a strength and again reverse up takes typically 2 to 3 years, believe me. Okay. Anything that is turning before that is a good swing that you can play with. But if you're really talking about long-term trend, talking about solid trend, de-risking yourself, wait for 2 3 years for that downtrend to stabilize, to start moving up. We'll start looking at these live cases down the line. So what these cycles really work upon, they are forming a kind of a 4 stages within them. Okay. These are accumulation, markup, distribution, and markdown. We'll look at them in the detail. Then apply technical analysis to spot crucial trend changes. This is where it introduced me to technical analysis. Then how to select the stock. A beautiful analogy is given here is that forest to tree to the approach. This is a very good approach to pick up the stocks. We are having around 4K plus stocks. Even if we make a scanner today, there will be 200 plus stocks coming in our scan. From there, how do I really drill down? That is where this concept helps me. Then, while you do all this, risk management is always crucial. Remember, risk management is always crucial. Why? Because if you finish your ammunition, if you are in a war with an enemy, you finish your ammunition before you can kill him, there are high chances that the enemy will obliterate you. So, what is your ammunition in this market? Your capital is your ammunition. If you end up spending it left, right, and center, you'll have really less amount of money to fight back. So, to be able to fight back, always make sure that your capital is your ammunition. Keep saving it. Reduce the damages. Reduce the things hurting you as much as you can. And that is where risk management is very, very crucial. And this book very well recommends that you should remember to protect your capital during market downturns. Do not be in the market every day, every month, every season, because the season changes here. The season keeps on changing. It should not happen that you are wearing a raincoat when it is outside sunny out there. It should not happen that you are wearing a sweater when it is sunny out there. So remember that, like the seasons, all the stocks are going to move around, market is going to move around. You have to keep on being in and out. You have to change your approaches as per the market trend. So these are the critical points that came out of this book. Now, in terms of interpretation, what I really learned out of here. So the major thing I would like you to look at is the concept that is given in this book from the page number 30 to 45. If you look at the page number 30 to 45, this is the game changer. That is this particular stage diagram. Stage chart is something very, very important. And secondly, you should also understand the volumes, the impact of volumes on your positions. We will study about it more. Now let's come on to the key interpretation that I pulled out of this book. Number one, I really understood why I was mistiming in the market. Why we mistime in the market is mainly because of the insider's game. What happens? We look at a particular fundamentals of a stock and we go and put our money in it. Okay. The fundamentals are gung ho, they are great. And what happens? The stock is rallying. Okay. At what frequency we get the fundamental data? We get it every 3 months. Okay. And actually, it is running 4 month delayed. So fundamental data is 4 month delayed for you because last quarter the calculation happens, the result comes a month back. So you get fundamentals data at a delayed frequency of 4 months. And in between these 4 months, what happens? Result are great in this quarter. People jump onto the stock and the stock starts running. But suddenly, stock starts correcting. Stock will start correcting suddenly. You'll wonder what happened. Fundamentals are great. I have analyzed it superbly. So many Twitter handles, so many market gurus are talking about this stock. Why the hell it is correcting? I'm just wondering over here, but I do not exit. I do not exit thinking that I am a long term investor. I believe in the story of the stock, and all those thoughts start coming in my head. Actually, in the background, what is happening, let me explain. When the results are given, they are published, they are with the public, people run along with the stock. But what happens within the company in the real time, we don't come to know. In the real time, if the raw material prices are increasing, in the real time, the company is struggling to get new customers, in the real time, if there are rejections at the end of customers, in the real time, people come to know that government policy is going to change. What will happen? These guys are not going to come and announce it on the television. These guys are not coming and going to announce it on Twitter. Why? Because if they announce, prices will fall. So if they want to exit the stock, they will get poor prices. So what do? They will start selling first. They will start selling first, and being just focus on fundamentals, I will keep arguing with the market and I will end up losing my money. You're getting me? So if you're questioning yourself that why certain stocks do not run, why certain stocks correct, while the fundamentals are same, fundamentals are good, most of the time it is the insiders who are at play. And insiders are people who are having high net worth. Many times they are institutions also, and they have huge chunk to exit. So they just cannot exit in one order. So they keep selling. And as a novice, I do not come to know that things are actually changing and I'm hanging on to something which is an old perception. And that is where we lose a lot of money. Now, how to correct this? So this is where the technical analysis helps you. What will happen when the insiders start selling the stock? So the insiders has hidden the news from you, but his action is transparent. Why? Because by the God's grace, the NAC and BSE keeps on sharing us the price data every other millisecond. Because of their grace, we can figure out big volume selling is happening. We can figure out prices are falling. And if we come to know that prices are falling, and without arguing, without using any argument or questioning this price move, if I keep on exiting myself, what will happen? There is no reason for my exit. Why did I exit? I don't know. The prices came down, I came out. After 3 4 days, I will come to get a news that government is bringing a open offer for sale, which is at 15% discount. Somebody out there in the industry knew about it in advance. Prices corrected, and good lord, you heard about it and you came out. You didn't argue. Somebody out there figured it out that government is going to play with the ethanol policy much before it was there in the news, and the price is correct. I also sweetly hear about it and I come out. This is the beautiful way that this book really introduced me that how technical analysis can be played along. So if you want to bet on a stock, go with fundamentals. But if you want to trail a stock, go with technical. A beautiful combination this book really introduced me to apply in my studies. I'll give you a very beautiful example about this. You'll not believe how finely it works. There was a time, I remember it must be around 2020 or 2019, I may be forgetting the time. GMM Fodlers were running very strong on the chart. GMM Fodlers were running very strong on the chart. Suddenly, there was a 20% cut, 20%, 10% cut within 2 days in the stock's price. People are wondering, hairy, scary. I exited. I exited. As per my rule, I exited. Now, what happened? Then the news came the company has issued the shares to its partners at a price which was absolutely at 200 moving average. Believe me, You can look at this event when it happened, look at the price at which they gave their shares, and look at the chart at that time. You will be surprised that absolutely the price at which these stocks were given to their partners were at 200 period moving averages. So this really bestowed me the trust that really averages are looked upon in the market. Smart people are using the averages. And this is where the concept came into me that yes, if you want to beat insiders, be on the technical analysis side. If you want to ride them also, be along with the technical analysis side. But to safeguard your investment, be on the fundamentals also. So this is where that techno funda approach really comes in front of you from this particular book. Okay. The stock prices moves in cycles. Now this is a very, very interesting topic. Stock prices move in 4 phases. We will deep dive on it after a moment. Most money is made when the market and sector trends are on our side. This is what is his forest to tree approach. Remember this approach and follow it strictly. You will really make good money in the market. What happens is that market is a crazy business of fad. Market is a crazy business of fad. There are certain sectors which suddenly start doing well, and then it pulls the crowd, it pulls the money, and it just zooms off. Now, instead of working with a great fundamental company which is there in a sector which is not that much in limelight, if you really start working with a great fundamentally strong company which is in a sector which is in limelight, you actually make great amount of money. Best example, railways, green energy stocks. In fact, green energy stocks just yesterday, if you observe, while the market was in red, green energy stocks were in green because of the bus policy decision that the government has taken. Now, this is where the sector and market trends matter, right? So, if you want to take from me, if I really want to look at what Stan is telling over here, is that look at the market trend first. First, the market should be in an uptrend because that is where people are ready to take risk. Remember, you will make money in the market only if you can sell your stuff at a higher price. You can sell your stuff at a higher price only if a buyer agrees to buy at a higher price. And a buyer will agree to buy at a higher price when his risk appetite is high. And when is the risk appetite high? When the market is in euphoria, market is in uptrend. So that's where market uptrend is very, very crucial. You will find other authors also designating around 60% of their success to the market trend itself. बारिश हो रही है, that's why everything is green. So remember that first thing always you should track for is the market trend. Secondly, that is your forest. Secondly, what is the green other bush? From that bush you move to the from the forest move to the greener zone of the forest. That is your sector. Sorry guys, though I'm an engineer, my writing is like a doctor's. Okay, I'm very sorry about it. So market is over here, the sector is over here. Then look for the sector which is booming, and from this sector, now go to the stock which is leading it. Right. So you have the market. It's a three-piece cake I'm talking about. You have the market, you have the sector, and then look for the stock, the leadership stock, which is there from that particular sector. Now, this is the forest to tree approach. You have the forest, you have the greenest zone of the forest, the bush, and finally the tree that you are focusing upon. And this is how you should keep on building your portfolios, keep on building, keep on aligning. Like you are going on a sail, yeah, you are sailing in the sea and you just have the sail to help you. What would you do? Keep on changing the direction as the wind changes. That is what you have to do in your portfolio. Keep on shifting your portfolio towards the sectors which are performing well and come out of the sectors which are performing weak. Simply you will find that your results improve a lot. Second thing, that is where the de-risking comes. Learn to sit on a cash when markets turns unfavorable. This is really a tough thing. We are so used to taking some action. He made some money. He is still making the money. Market is in downtrend, but that guy is smart. I also want to try it out. Don't do that. Learn to be on a cash. And how do you hide the cash from yourself? I would use a liquid bees. Simply when the markets are cooling down, 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 take your cash out of the market and put it into a liquid bees. Because if the cash is not in front of your eyes, you will not act. The moment you will try to put an order, it will say no funds available. That is the situation you should always have. Now, why sitting on cash in an unfavorable market is very important? I'll tell you the psychological reason behind it. The psychological reason behind it, just give me, I don't know why the focus of my cam has changed a bit. Let me just restart it. Okay. Still, it is a bit distorted.
Sir, if I ask,
You got muted, please.
if I ask one question, that what should be the allocation that any investor should give on fundamental or technical analysis, what would be your suggestion?
I would go 70% with, wow, it got fixed. I would go 70% with technical and 30% with fundamentals.
And what are the tools that can be used for the better technical analysis of any stock?
I'm a very lazy guy. I'm highly dependent on scanners, and the best scanning tool you have in India is the website charting.com. So I use technical analysis, charting.com. Fundamental analysis, I would use screener.in. And even I work with the guys in the US, they feel jealous about the capabilities that charting gives in India. Frankly, at least for positional, charting does a wonderful job. Two big I think the gaps in it, it doesn't scan the BSE stocks, so be careful about it. For that scanning, try to use TradingView or try to manually scan it. And otherwise, yes, Screener is beautiful in terms of its real-time updates on fundamentals. So that is what is the two set of tools that I use. Yeah.
I think the allocation that you set for technical, that is 70%, clearly signifies the importance of analyzing the trade and analyzing the industry before you are going to take any trade.
Actually, the trigger for me is technical and validations for me are fundamentals. That is how the approach is. Because if the stock is not running, it is of no use to me.
Definitely, sir. Definitely.
Got it? Okay. So I'm not somebody who is comfortable to sit on an egg and wait for it to hatch. Rather, I'll look at the chicken who is coming out. Which is the healthy one? Let's go with it. Okay. So this is the approach that I have. So now let's look on to the, yeah, I was point to the point that learn to sit in a cash when markets turns unfavorable. This is very, very critical, guys. Psychologically, I found it is a big game changer. Why? Let me tell you. What happens when the market falls? What happens when the market falls and you are invested? You are invested in the market and market falls. The perception of fear really builds very strongly in you. The perception of fear grips you because you see it is red, I'm losing money. Day by day, I'm losing money. At 16,000, the Twitter spaces are full with 12,000 and 11,000. And then you panic, what the heck people are talking, and I'm locked up in this market. The perception of fear will be big if you are invested in the market when it is falling. Rather, now look at it differently. You are smartly out of the market at this point when the fall starts. You're out of the market. Now, what will happen? Now, your hands are itching. Now, your hands are itching. When should I take an entry? So, instead of fear, your mindset is opportunity. You're looking at opportunity now. Now, the falling market is not making you panic. The falling market is getting you ready that at some point this guy will make a base and it will race. I have to spot that place. So your eyes are open, your thinking is positive because you are out of the market. So that's the reason I recommend. And I also observed personally also that when I'm out of the market, when it is falling, my mind is more clear, my thoughts are more open, I am more receptive to the bounce that would come in. I'm not in a denial mode. But the guy who is afraid, what will happen? The guy who is afraid, the market has fallen, he's still afraid. Market start rising, his head is in a denial mode. No, 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 no. Still the problem is there. I've already lost so much. I'll again lose. No, no, no. Why? If I'll have to book losses now to re-enter again. Let me wait. Let me wait. Let me wait. What happens? He has invested in banks which were running very good when the market went up. But when it turns up, it is the PSU power stocks which are coming. Now what will happen? His banks are not performing. So though he sees the market is coming up, he is not able to make up his money. Instead, if he would have exited here, sit on a cash with a blank slate and a clear mind, he would have easily shifted to PSU stocks and he would have made money. Understand this psychological part also. Why exiting at the retracement is always better, because the next season different fruits, different trees are going to grow. Old trees are not going to give you fruits. Now the different trees are going to give you the fruits, right? So move on to those trees, collect those fruits rather than getting hooked up and getting bogged down and waiting on a season, on a trees where the season has gone off. Got my point? So this is very important thing. Why sitting on a cash in an unfavorable market is very, very critical. Okay. Now let's look at the core concept that he has brought out in this book. So in this book, remember that he is focusing on 30 weeks moving average on the weekly chart. He is talking about the 30 weeks, 30 periods moving average. I'll not go into the details what the moving averages are. You can always build that concept from outside world. So this is what his strategy is, simply that if the stock comes up from this 30 period moving average, making a kind of a base structure, he will move on to the next stage, and that is where the uptrend starts. He makes money. Then he keeps observing around 30 WMA. When it falls below 30 WMA, he makes an exit, and that is where he's safe in the downturn. Okay. Now let's understand what four phases this guy is talking about. Now this is something which is very, very peculiar, and you will find it common across books for 1 century. Believe me, this concept is 100-year-old and still running hot. For 100 years, this has made money for the people. How? Let me tell you. In 1920s, it made this same concept made money for Charles Doves. So Dove's theory you will observe. You will observe even Wyckoff, Richard Wyckoff, using the same concept. Both guys in 1920s. Then there was this guy called as your Darvas. You know the Darvas box, right? So Darvas also was using the same concept, and he was using in the 1930s till 1940s. Then came another author who talked about it, that is Stan Weinstein, in the 1970s. So you can see this system has already survived for 50 years. Then came the next generation of authors in 2000s. It was the same concept which was talked 2010 pre. This is the same concept which is talked by Mark Minervini. Believe me, this one chart has survived through this at least 3 generations of the investors. So this is the core of the market. You definitely understand this. It comes out as a theory of market phases by Charles Doves. This comes out as Wyckoff's theory by Richard Wyckoff. This comes out as the boxes theory by Darvas box. This comes out as stage analysis by Stan Weinstein, William O'Neill, and Mark Minervini. So this is a must that I follow. I would also recommend you to study and understand this. What this concept really tells you, that whenever there is a fear in the market, the prices would fall down. Why? Because people want to de-risk themselves. They are selling off, exiting the stocks. As they exit from the stock, the prices fall. But during this fall, what happens? Government policy changes. There are reasons why market fall. Those reasons starts getting evaporated. Slowly, the war goes away. Political stability comes. COVID vaccine comes. All these things start happening. And who senses this first? It is sensed by the big institutions. Big institutions have big researching capabilities. They have experts. We as individual, We do not have that much of expertise, right? So how do we make money? We just piggyback them. We just wait to find where they are entering and where they are taking their positions. And that is where this accumulation phase is formed. What happens? A big investor here will start adding the stock, say at the level of 950. He is adding the stock. So this creates a kind of a support, a bounce zone. Price comes here, buying comes, bounces. Price comes here, bounces. Price comes here, bounces. So this creates a support zone. Up there, what is happening? There is another residual seller in the system. One big institution was there which wanted to exit, but it just didn't agree for the price that time. Then it decides that at 1000 I am going to sell. Now, what happens? This point creates a resistance. Price reaches here, selling comes. Price reaches here, selling comes. Price reaches here, selling comes. So you have a ceiling, you have a floor, and ball is bouncing between them. Now, this creates a zone which is called as a sideways zone. I call it as a zombie zone. Zombie zone is a place where the behavior of the stock is very crazy. Goes up, comes down, goes up, comes down. It hits your stop losses, again bounces up, gives you hope, again you enter, again hit stop losses. So this zombie zone is very dangerous. Typically we avoid entering over here because it can take long to resolve till the either of the party really dominates and comes out of it. So if your buyer is very strong and he can add in huge quantity, what happens at one particular point? This selling gets exhausted. This seller is thrown out of the stock. The moment this seller, the big seller, is thrown out of the stock, what happens is that a big chunk is cornered by this guy. A big chunk is cornered by this guy. And why is investing? He's investing to push the prices ahead. So with so much quantity cornered, there is a shortage created now in the market. Okay, like your onion potatoes, if the stockist starts stocking, our prices start rising. Simple game happens here. He corners the big quantity. Now he wants to push the prices ahead. And they get pushed. Why? Because now in the system, the residual sellers are small. These guys are having small quantity to sell. And this guy can start buying it, but all these guys are demanding more price because the moment this guy wins, they become greedy. And for buying those quantities, the stock shoots up and it shoots up very fast. Why? Because there are other people in the market who are watching this fight. The moment this spot comes up, the breakout comes up, many external partners join in the party, and you would see that the stock prices rushes up. Now, as per this book, as per Mark Minervini, as per William O'Neill, this is the best spot to enter the stock. Why? Because if you observe, staying invested anywhere here, you would lose money because you don't know how far you are going to fall. Staying invested in sideways zone is very tough because you don't know who is going to win. There are times when the seller will win, you will lose money. So better wait for the dominating party to evolve. The moment this guy wins, you take the safest position and entry over here. This phase is called as an accumulation phase. Typically, a sideways zone with more volumes on good buying days is a sign of an accumulation phase. The stock cornering phase, I call it. Okay. Now this zombie is dead. He has got an injection. He has got a what I would call it as a vaccine or a drug now to start running. He gets a drug to run. The dopamine rises and the stock starts running very fast. Now this phase is called as a markup phase. Okay. The stage analysis, they call it this as the stage, I think stage 2 they call it. They call it this as a stage 2. This accumulation is stage 1. So from stage 2, again the stock will start running and it will encounter intermittent selling. Why? Because people up here might have some good quantity to sell. Plus, there are weak hands who joined the party here and here. They want to cut their profit in 10%. There are people like that. So again, a resistance zone will get created over here. What happens? If this guy, remember, if this is not always, if this guy is still strong, still interested in the stock, he is going to eat them out. He is going to roast them and eat these sellers and give you another breakout. another breakout, and the stock will run up. Got it? So you will observe that journey of any stock will happen like this: fall, correction, rises, makes a flat zone, rises, makes a plateau, rises, makes a plateau. So in step by step, it keeps on moving. Okay. Now, what happens finally after running a good amount of distance or certain distance? There is a sense of risk that evolves in the head of this guy who bought it here. He starts thinking that enough of the money that I have made here. There are two, three reasons why he would sense a risk. Number one, the business environment really doesn't improve. Number two, company doesn't perform. Number three, better opportunity somewhere else. Remember always, a stretched position is always risk. A base position is always opportunity. So he might think that enough of taking risk, let me check out. Now what happens? He will start selling over here. Now he is having huge quantity to sell. He cornered huge, so he had huge quantity to sell. He cannot sell it within a day, so he decides that 2000 will be my selling point. Now what happens? Prices go stuck there. Prices go stuck there. And then there are retail investors, bola bhala naive retail investors who come to know from their neighbor, I made money in Tata Elxsi. My uncle made money in Tata Elxsi. My friend made money in Tata Elxsi. Now Tata Elxsi is correcting. Person on TV channel told me, bye, bye, bye. This is something that you should definitely catch up with. And he goes and buys here. But retail investors cannot buy in huge quantity. Unfortunately, they don't have that much of money. So this selling that comes over here now starts eating these buyers. It start eating through these buyers, and stock actually corrects over here. Stock actually starts falling over here. This becomes your stage 4. This distribution is your stage 3. This runaway rally that you get is your stage 2, and this is the base that you have is your stage 1. Now this distribution zone, you can figure it out by a sideways zone at the top where selling is more on the volume is more on the selling days. So this is how the market cycle keeps on happening in the stock where institutions are involved. Believe me, there are stocks which will never have this because there is no big fellow interested in running them. So wherever you find them, that is where you should work, because that is where some big fellow is involved, either HNI or an institution. And this is what actually helps the retail fellow to ride this rally. And how does he ride his rally? The best thing is there, he should buy here at a breakout and he should here sell at a breakdown. This exit is very, very critical. So you enter here, you exit there, and you make money in this particular phase, which is phase 2 plus phase 3. Now you will ask me what way this is related to Darwa's box. So Darwas was smart. He used to mark this sideways zone with a boxes. He would just mark it with a box. Then what he will do? He'll put a buy order above, sell order below, buy order above, sell order below, buy order above, sell order below. Nobody would have told you, but I am telling you by my observation. Darwas was not a technical analysis, just a jugadu guy, a smart guy. But fortunately or unfortunately, he ended up getting this breakout and ended up getting this breakout. And he also enjoyed the same journey. 1,000+ year concept, just use it in the market and make a good money. Now, for the long-term players, Mark our Stan Weinstein spots it as the 30 WMA. So this is what can be simply used to spot an entry and then manage your exits. So this is something that I would suggest 3 things to come from this book. Number 1, follow the trend. Okay, don't play against the market. Number 2, use the forest to tree approach. Go for the market uptrend, go for the sector in a good uptrend, go for the stock with a good setup. Number 3, yes, this theory of market phases along the line of 30 WMA. Any questions over here if you guys have? I will spend around 5 to 10 minutes over here, please.
Yes, sir. As correctly being spelt by you, that understanding the psychology of the retail investors is very much important, and analysis of market, doing the due diligence of the stock price movement is very much important for making the profits. And as we all know, that learning is very much important to make the good earning. So if there are some questions regarding the technical analysis, that how much time should one invest in doing the technical analysis? Like, what is the duration that one should look for the charts? Will that be of 3 months? Will that be of 1 month? Will the chart be read for 15 days or 7 days? What is the appropriate time for reading the chart? Like, how much duration should be referred?
Yeah, so it is like building a relationship. Very simple. It is like building a relationship. You are new at a workplace, right? New at a workplace. For you to convince your boss will initially take time. Okay. But as you take this journey many times, you'll understand what works with him, what doesn't, right? And then with time, this time really reduces the time that you spend in analyzing the market and all that typically reduces very much. For me, from where I started, it is at 10% currently. I have cut it down the 90% of hard work I used to do. Because with time, as I told you, you understand what the market and how it works, and then it reduces. For this 30 WMA strategy, it's very simple. You have to just work on a weekend. But if you're somebody who works on the daily chart, then you should be working on a daily chart. Typically, for me, I spend half hour on a weekend to analyze weekly charts. And if I comes to daily charts, yes, again, I take around half hour to go through all the daily charts because I am using 4 or 5 strategies as I teach people. I keep observing all of those strategy. You can wrap it up in 15 minutes also on the daily basis once you really build that journey.
We have one question from Dhruv Prakash, sir, that now actually there is a continuous uptrend as far as index is concerned. But stock in specific may be in different direction. But what in-depth study to be made to sail with trend?
As I told you, what you have to really look at is always look at the market trend. Sorry. Do not look, the whole zone that you're observing, first of all, should be smaller in the market. Okay. So, first look at the market trend, then look at the sectors that are working. Okay. So, like railways are working, like power sector is working, like defense is working. Just work in the stocks which appear from these uh, industries, and that is where it's sufficing. So bring down the zone on which you are acting upon, and that automatically will reduce your time for looking into the things. So how do you look at sectors? So typically you can open the sectoral charts of those particular sectors and look at it. Then you have money control, then you have stockage, which keeps on giving you those inputs around which sectors are running strong. Plus your eyes can observe on the chart which kind of stocks are appearing every day on a new high. So these are the ways that you can spot the sectors which are good for you. But always learn to say no a lot. These reject should be more so that the set on which you work is smaller, and then it becomes very, very effortless.
Definitely, sir. Another question from Keval Shah, sir, from Surat. He is asking that how can price fall without much volume? Is there any correlation, or it's just the operator play that happens?
With a lower volume, what happens? Typically, a retailer panics. Yeah, retailer just gets panic and he exits, and the prices fall because the big guy is not interested. He is not planning to buy now. Simple thing. If he has bought here a lot of quantity, he has bought here a lot of quantity over here. He is not bothered with 2-3% fall over here. And these are the falls which are then created by the retailer. But if you get a follow up selling, then some big seller is going out. So this is how you can figure out that lower volumes are not to be that worried about. But if it continues for 2-3 days plus a bigger volume, that is the point where you can conclude that the big fellow has come to sell.
Another question from Jaipur by Sumit Jain. He is asking that is the current market in euphoria state?
Frankly speaking, I am a guy who just follows the market. I do not worry what phase it is. Seriously, for me, the rules are simple. If it is above certain averages that I am tracking, I'm happy with this market. If he comes below this average, then I will exit. What happens, no? If I start judging the market and labeling it euphoria market, I convinced myself that this is a euphoria market. What will be my actual reaction on the floor? I will not take entries in the stocks. Okay. And the market can continue running, right? So always better hai, just walk behind the donkey with a safe distance, I would say. Following the market is following a donkey from a safe distance. If it kicks, should not touch you. That's it. If it starts kicking too much, go far off and leave the track itself. Let the donkey go. Simple thing. My relationship, what I talk with the market in Hindi is that मेरा और मार्केट का रिश्ता बहुत ही अजीबो गरीब है. जब वो ऊपर जाता है ना, हम दोनों साथ जाते हैं. जब वो नीचे आता है ना, वो अकेले आता है. Like our friend, no, some of our friend, they lose their mental health and they start kind of fighting with us and they argue with us too much. What do? Thanda hone do na, let him cool off. Then we will again start talking. That's
Yes,
what you have to do with the market. Let
yes.
him cool off.
Waiting for the opportunity.
That's all. That's better.
Yes. Another question from Jaipur by Sumit Janser. How significant the PE ratio is in overvaluation and undervaluation?
Yeah, we will talk about it in the coming books. Okay.
Definitely, sir. I would like to take one more query from a global citizen, that is Pramod Padi from London. First of all, I would like to congratulate and welcome him for the time that he has given. Could you please explain one more last time, this last stage in the market stage, when to come out of a stock?
Yeah, if you go by this book, what this person, what Stan is doing is that he's observing this period moving average over here, 30 period moving average. So whenever he gets a candle close on the weekly basis below this 30 period moving average, he plans to move out. So typically what I try to do is that I try to use a particular moving average. You can also try to use a moving average to plan your exit. The beauty of moving averages we'll pick from the next book. So that will also give you more confidence and comfort with moving average.
Definitely, sir. Since you are talking about the moving average, I would like to ask one question regarding that only. From Sujay Kumar Sinha, sir, from Kolkata. Are WM and EMA the same?
No. WMA, if you are talking from the weighted moving average point of concept, it is different. But if you put a exponential moving average or a simple moving average on a weekly chart, it becomes WEMA or WSMA. So that is where conventionally it is called as WMA. So typically here it is a weekly chart, simple moving average of 30 days. Whenever you go positional, typically I would go in a simple moving average. If we are doing intraday and short term, then we go in a EMA mode.
Definitely, sir. Definitely. Would we like to have some more queries to be taken up or conduct the queries later on?
Yeah, we will have it later on because I see the clock. It is
Yes,
going.
sir. Yes, sir.
Okay.
Definitely.
Right. So now this was the first book that enlightened me to that. Okay, let's have a technical analysis also a part of my storytelling, and let have fundamental analysis of my storytelling. So both things now has started working together with me. Then what definite question came is that let's understand more about the moving averages. And the best book to learn about moving averages that I have figured out is this book, Moving Averages One-on-One by Steve Burns. Now, this book, if you remember the Navneet guides that folks at my level had, or even you guys might be having, now, these books are very, very thin, right? So, Navneet guides or these exam guides are very, very thin. And if you want to underline anything, you end up underlining the whole book, right? So, this Steve Burns book is a very thin book. So, this is the book. So thin it is, right? This is around 440 rupees. You get it on Amazon. Now, this is a game changer book. Again, it changed my life for better and made it very, very easy. So, here we will now try to deep dive into what concepts that come out of this book by Steve Burns. So, the some of the important concepts that come out is that moving averages actually help to smooth out the price data. So, you are having price moving in a volatile manner. You cannot figure out, are we going up or are we going down or are we going sideways? So that is where if you put a smoothened average line below it, you get a good idea, right? Then in this book, Steve Burns observes and talks about the specific moving averages 10, 20, 1, and 5 moving averages on the EMA scale, because these are short term play that you do. So he uses EMA. Then 50, 100, 200, he uses as the SMA. Okay. Change in trends can be identified with moving average crossovers. Why this is important? I told you, right? Whenever the uptrend starts, I want to be an early entrant into this. This is something which moving average crossovers help you to find out. Okay. Another beautiful and the most important application of moving averages is that it acts like a support and resistance zones. Beautiful concept, very powerful concept, very easy technique to manage in the market. Now, if a moving average is acting like a support, if a moving average is acting like a support, stock is bouncing and walking along with it, what is the easiest stop loss that I should have? The moving average itself. So if this bounce fails, my story ends. That's so easy that you can figure out with a moving average. The exits you can plan your entries with crossovers. So that's a beautiful thing that I observe. Combining moving averages with other technical indicators is very much required for a more comprehensive analysis. What happens is that moving averages actually tell me the safety. Moving average tells me the safe zones where the things are in my favor, the risks are less. But from these safe zones, will I get the strength to fly up fast? So that is where I'll have to use other indicators like an RSI. So in this book, he does discuss about RSI and MACD also. So in the last few pages, you can look at that also. It gave me a good amount of clue in developing my strategies down the line. So that is another beautiful thing in this book. And as I told you, moving averages can be used as a good risk management tools. So these are the key mantras that came out from the Steve Burns book. Believe me or mind you that Steve Burns works in a US market. Okay. So these are the averages that he came up with. And I typically find in Indian market, 5 is of not much use to me. So I don't use 5. Instead of 10, 9 EMA works good for me. 21 EMA also works good for me. And from there onwards, these are the SMAs on which we work, right? Now, what are the key inferences that I really pull out of this book? Okay. The number one thing that I pull out of this book, this is a very important concept. Remember, focus on this. Moving averages give me historical price context to make decisions, to figure out stretched versus safe stocks. I believe you folks are into auditing, and a lot of the time we audit the purchasing process of the client. We audit the purchasing process of the client, and what do we really observe there is the cost basis. At what basis I calculated my buying cost and I really released my purchase order. Now, this cost basis, where does it come from? For 80% of time, it comes from the historical references. You know, if I'm going to buy a carpet of 70 by 80 today, I will try to find the same carpet around 35 by 40 if I bought earlier. What was its price? Try to put it proportionally to get a thumb number that is safe to buy the uh, this particular commodity, right? So this cost basis is coming out of a historical price context. Now, if you don't have an historical price context, you cannot judge whether you did the right job in buying at that price or it was a messy job. Getting my point? So, like that, in our professional world, the cost basis is important. On the chart, moving averages gives me that particular decision. Am I buying it at a sweet spot? Simple language. Am I buying at a sweet spot? The sweet spot is where it is safe to enter the stock. And how, what way it is safe? Let me take you to a very, very simple and real example that just happened in front of our eyes. Okay. So I'm going to go on a daily chart. Okay. Let's go for 1 year daily. And I'm going to take a stock called as Venus pipe. Um, So you would observe that many time on the charts, there are stocks which start running along a particular moving average. Now this is the stock of 1 year for Venus pipes. Okay, so I'll just remove the noise from my chart. Okay, what this chart is very easily telling me is that the moment this stock took off from here, it is taking support along this 20 moving average, simple moving average. Now, where is my stop loss? Decision is very easy. At this point, I am going to come out of this particular stock. So, you would observe that if you want to play with the stock, use this simple concept. Open the stocks and choose the stock which are walking along a particular moving average. Simple model. Walking along a simple moving average. Now, this is your gravita. It is walking along a simple moving average. Where do you make money in the market? Is always above a moving average. You make money. Where do you lose money in the market? Below the averages. Now, what happens actually when you get stretched? Whenever you get stretched far away from average, people are not comfortable to buy that particular stock. That's why you'll always observe sweetest spot to get into the stock is near the averages. Riskiest spot is when you're far away from the averages. Like let's take out the case of KPI Green. Just forgive me, guys. At times, if there are splits or bonuses, the charts come distorted in charting. So, in case that happens, sorry for that kind of waste of time. So now you will observe in case of KPI Green. Now it is you can observe over here that 20 is not working well with me, right? So what I will do, I'll simply try to put another average over here, say 50. Is 50 working here? Again, this is also something that I'll have to watch that 50 was working before. So 50 was working before. Now it has given a breakout. Now if I try to look at this stock, is it good to buy this stock? No, because I am stretched. Whenever you are stretched, the next guy who comes to buy will not be comfortable to buy it from you. Then what happens? There are corrections till you get the next buyer. And this is the places where you'll have to hop on or hop off from the stock. So now you can observe the guy is at 9 period moving average where the bounces are coming. So always remember that far away from averages, risks build up. Closer to the averages, the safety is there. Okay. Now, whether the strength is not there and other thing that you can check with the other indicators, right? So the first thing first that I would like to impress here is that you make money whenever the stock is above the averages. You lose money whenever the stock is below the averages. You have the most efficient point of entry in a stock whenever it is near average. I'll give you a very good case which is hanging around in front of me now, Gensol. Okay. Now we are looking at Gensol now, right? So many time you can observe over here is that you are getting a buying volumes here and the stock is crossing the 50 MA. The stock is crossing the 50 MA and this is where you can see over here that volume has also come in. Now what I have to do is that I'll have to check now that if I start riding from here 50 MA is near me, right? Now what is going to happen? This can be used as a stop loss for me and I will start working with it. Now as it starts running, it might start aligning with some other average. Then my gear shifts. Maybe I'll start observing here. 9 is also not working, so I'll observe 20. So I'll shift my gear that, okay, now 20 is my safeguard. So this is how you'll have to shift your trailing gear and then you can plan your exits. That is the beauty of moving averages. Moving averages give you the context, historical price context to decide whether you are buying a risky stuff or you are buying a safe stuff. That is the one big thing. Secondly, moving averages act like a support as well as they act like a resistance. So for this, I'll give you an example of Zentek. Let's look at Zentek. So nice defense stock was running strongly, but then the story got spoiled. So you can observe over here, all this point here, 50 MA was acting like a support, then it fell down, it started acting like a resistance. Then again, it has acting like a support. So the story is turning around this moving average. So this is point where I'm going to observe it. And these all decisions starts becoming very, very easy in the market. Why I love, even when I share with my students, I stress a lot around moving averages. Why? Because, there is no ambiguity in then what support and what resistance I am looking at and you are looking at. It is very, very easy. But if I draw Fibonacci, if I draw Fibonacci, I can draw it from here to here. But as a student, you might draw it from here to here. Now, who is right? Right? So these kind of confusions arrive if you start using such tools like Fibonacci or even Elliott waves. A, B, C, D, 1, 2, 3, 4. You would look at like this. Somebody would look at different way. So this ambiguity also is not there if you use the simple moving averages. So I have a saying, na, there is no average about there is no average about simple moving average. It is a special concept. The concept of simple moving average is not an average concept. It is a real special concept. Okay. So these are the ideas that came up from this book. Okay. So things that I would use,
I've already
no more.
taken the query of P.A. Nandakumar sir, who was requesting for showing two charts where this can be traced.
Now itself.
Yes, sir, but you have already taken this query without even telling that. You have shown that how the funda and how the philosophy works upon charts.
Now, if you see, Gensol is from green energy, hot sector. Zentech is from defense, hot sector. So it's very simple. Another guy who is coming out of this is Olectra, right? You will see, you will observe that how the heck this thing works in the market and why the hell we are worried. Market are difficult and all that. It is just human behavior and keep observing. Put your lenses on and keep observing. You will come. The game will teach you the game. That is what is said by Jesse Livermore. The more you work, it will start simplifying for you. This is what is the thing coming from Olectra Green. Same thing, you see the bounces happening 50-50. 50 acting as a resistance, now 50 acting like a support, right?
Yes.
You know, moving averages are like our good friend. Sometimes they will throw us out from a party and sometimes they will welcome us. Join them when they welcome. When they are not in a mood, okay, I'll go to the next one. Got it?
Yes, sir.
Right. So, no more buying in the dip mindset. Never buy in the dip. Okay. Never buy in the dip. Instead, let the strength build up. And how do you find the strength? The stock moves above the average. That is your strength, point of strength. From there, you can build up the story, right? Moving averages told me the zones of support or resistance on the chart to choose better trades. Now, there is a zones. How the zones are created? Simply what happens whenever we know that base is to be made, base is a sideways zone. Sideways zone is when the price is stuck between a range for a longer duration. Automatically, what will happen to the averages? They come together. They come together. And remember how the rope is made? Just look at the analogy of how the rope is made. So you will observe that rope is made out of small, small, weak threads. But the more they wind around each other, the more they wind around each other, what do they create? They create a strong rope. And this is what happens. The moment you see these convergence zones, I call it as my bunker behind which I fire to my enemy. These are my bunkers. Till the time my stop loss is falling below this bunker, I am safe. Even if the enemy fires on me now, I will hide behind this bunker till it gives me support. Again, I'll collect my ammunition. Again, I'll move up. But if I enter into such a situation where I'm far away from the bunker, where is the bunker here? My bunker was here, where the convergence was there. I'm so much in the open. This is what the euphoria, this is what is the greed that causes you. How can you spot the greedy spots? Away from averages is the trap. Near the averages, my good friend, that is the bunker. Fire from there. Even if things go against you, know you have that bunker to save your capital. High probability you will move up. But if you go in the open land and fire from there. You are right in front of the enemy, bang on, he's going to sell on your face. You are going to get killed. Getting my point? So this is something which comes out of the convergence. Okay. What happens? The small trends, they wind around, they create a solid base. Now this rope is strong. Now let's attempt from here. Probabilities. Market is a game of probabilities, my dear friend. There will be failures, but probabilities are higher over here. Why? Number one, the big boss, the market is in uptrend. Number two, the green energy, the bus orders 88 lakhs or some buses are to be ordered by government in next 7-8 years. How many manufacturers? You can count on fingers. Got it? And these are the guys who are already making inroads in Pune. Very strongly, I can see Olectra everywhere. You can see JBM a lot in Navi Mumbai. Other places also you can see. So these guys are strong. Sector is strong. Market is strong. Growth story is on with these guys. You have the runaway rally possible. Let's get on to railway, right? Why to forget railways? So railways, my dear good friend, which we can watch now will be RK Forging, right? Always look at, don't forget the guy who is lying low. Huh? Don't forget the guy who is lying low, because that is where the opportunity is going to come. Now, RK Forging, beautiful. You have this rope ready over here. You had a great rally. This was a risky zone. We are stretched out of the bunker. We fall. Now again, the ropes are falling together. Now, when these ropes are in place, we get strength. Railway story, we are still on with RK Forge. But within the railways, am I going to try with Titagar today? This is the question you will have to slowly learn. That is Titagar a good bet? No. Why Titagar is not a good bet? Because I'm away from my bunker. Now I'm in the open. Let's not enter here. Let it fly. It's okay. Good luck. फिर मिलेंगे कभी तो भी. ठीक है. And that is what happens. No, you miss a stock here, you will get him here. You might get him here. So this is what the journey is. You know, zigzag, zig. What I told you, the zombie zones, the rally zones, the sprint zones, the zombie zones, the sprint zone. That is how the market goes. So market goes in cycle. Everybody's time is going to come. Opportunity is going to be there in on your doorsteps. Just relax and watch. Don't rush into it. The more you rush, you'll get crushed. Okay. So
So we
this
have one query from Chennai from B. Shankar Kumar requesting you for your outlook on power sector.
again on the charts they are looking good, and we are going to be a power hungry country, highly populous, huge industrialization going on. The power demand is going to go up. And you know the guy who is on the sweetest spot on power today? You know a guy who is on the sweetest spot on power today? You will feel that all things are stretched. This guy is on a sweet spot, going by the theory which has been given to us by Stan Winstein. Simply, I will put the 30 period moving average and you see where this stock is today. So we are on the 30 WMA. This live case I was going to bring up, but here you can observe. The moment you observe there is a 30 WMA crossover, you can mark over here, and this crossover is coming up with volumes. There is a support of volume coming. And you know this good friend IEX, whatever profit it was making here, it is making more profit here. So fundamentally also a great opportunity. So power sector is good. This is something which I like in current context. I gave it on my Twitter handle, I think on Friday morning, and it did fire up 4-5%. So this is how you can just keep spotting the animals where they are in the jungle. Oh, someone is here, interesting. Let's get on with them. Okay. Right.
So there is one query from our viewer, Taranjeet Singh from New Delhi. He's asking for your opinion on the prices of PSU. Like, are they in comparison with private peers?
Uh, the PSUs, if you see valuation wise, they are still very comfortable. Okay. Chart wise, they are stretched. So since they are strong, I'm riding them. I'm riding them since they are strong. If they weaken, I will move out of them. That is my plan with it. Okay. And PSUs, they are running mainly because of the big gap they had, and the way this government has been able to really push up the infrastructure growth in power sectors and other areas. The whole investment gets routed through them. REC, PFC, they are feeding into these industry actually. So that is where their offtake is also growing to grow, and that is where the charts are running. So they are in strength. PSUs, by God's grace, yeah, I would love my country to grow, and these stocks will also keep on growing. But just because they have become pricier, should I move to something which is looking cheaper, private players? I wouldn't do that. Actually, I'll still watch the fundamentals of that private player also. Like, good guy who came out of this zone was Tata Power. Now he is a bit stretched. That is what I think so. You can see here, same thing happened. No, he has come out of this zone, and you see it is again taking support at 30 WMA, and he is going up well. So yeah, I think still if you're a long-term player, you can think about this guy, Tata Power. Yeah. But always assess your risk. Simply figure out the MA at which you are going to exit. So if it is 30 WMA for me, 254 to 332, it is 46 plus 32 is around 78. So 78 out of 332 will be around 22 to 23%. So if I'm fine with this kind of a stop loss, I'll work on it. Otherwise, let it go, let it correct, come in my zone, then I will work. That is what is my approach. Yeah.
Yes, sir.
And though we are talking about, going with the market and the sector and spotting the opportunity, let the stock come on your scanner first. Then you map it. Don't go that, oh, now I have to find a leader in this and I should jump on it. Don't do that. You might get trapped. So instead, have a contextual understanding, market, sectors, have a contextual understanding. Sit, relax in front of your scanner. What appears? Like IX appeared, then I mapped it. It looks good. We move, right? That is what we do. So that's why I said 70% is technical, because the trigger comes from there, validations comes from fundamentals. Okay.
Yes, sir.
Right. Another beautiful thing about the moving averages I observed was that it gave me a lot of flexible trading systems. So, everybody is differently wired. Why? Because there are three things which I believe change the way we work in the market, either short term or long term. Number one is my capital requirement. If my capital requirement in near term is high, I may not go long term. What I will do? I will go to the short term levels, right? Number two is my psychology. How much stomach I have to survive with drawdowns. Market, the stocks will correct like this. If your stop loss is here, you will still survive, but you'll have to digest this much of drawdown. Are you psychologically ready? If not, then what you do? Use a near term moving average. That's the flexibility that moving averages helps you. So you can become a short term player, you can become a mid term player, you can become a long term player, and very flexibly you can use it. But core concepts, remember, near the base. Entries should be near the base. Trail it with a smaller stop loss if you're a short term player. Trail it with a longer stop loss if you're a long term player. That is what is the approach that you use. You can do it, right? Another beauty of moving averages is that no need to remember my exit levels. This is the beauty of it. When I started technical analysis and attended some programs, training programs, what I observed that people would take decision based on candle. This candle is bullish engulfing. This is your baby candle. If you come below the bottom of this candle, you should exit. Now, what the heck here? How am I going to remember stop losses for 20, 30 stocks that I am working in? Not possible, right? ज्ञान देना बहुत आसान है. This candle, that candle, below this candle, look at the support level, look at the structure analysis and decide your stop loss. My dear friend, when you practically sit on a system and do it every day, you cannot remember these things. Then what do? You use the GTT order feature. You already feed in your stop loss. Then what the hell does is that market players, they hit your price and bounce during the day. Then you're regretting, why the heck I put my stop loss there. Now, to get out of this chaos, moving averages are beautiful and very peaceful. Just put them on your chart in Zerodha, anywhere. And whenever any stock is negative on a particular day, just look at it. Whether it is going below any certain average, take your decision. Very, very simple. So taking your exit decisions also became very, very simple when I started using the moving averages. Right. So the takeaway, number one, moving averages work beautifully as a support and resistance. Number two, above the moving averages, you make money. Below the moving averages, you lose money. Number three, flexibly design your system the way you want, as per your psychology, as per your capital requirement. That is where I complete this second book. Now, anybody has any questions still outstanding, please?
Yes, sir. We have few questions from our viewers. Um, one of the viewers named Regan Kumar from Sonipat. Regan, he is asking takeaways on IRFC.
IRFC,
Yes, sir.
I am really not comfortable with IRFC. I'll tell you why. I'm not really comfortable. Fundamentally, I'm typically not comfortable. So that is where I would put at it. Fundamentally, I'm not typically comfortable. And on the charts also, what I see is that, it goes in a sideways zone very, very frequently. So this is where I'm not comfortable with IRFC. I'm more with in Titagarh. I'm more with the your RK forging and HBL Power. I'm more with them because they are trending strongly. I am not comfortable with a guy who runs few kilometers and starts panting because again I have to monitor for its stop loss. But if you look at HBL Power and all that, these guys are running very, very well. So if you see here, the number of the zombie zones are less. More the zombie zones, I try to avoid those stocks, frankly. And IRFC, maybe you can take it as my weakness. I'm not good in analyzing the financial NBFCs and all that. You can take it as my weakness. But whatever I see over here, what bothers me is that, their growth is something which is not, see the profit growth minus mein hai. So it's not giving me comfort. This kind of a profit growth is not something that I am really comfortable with. Then you can look at EPS. Latest quarter is same as the previous quarter and is less than the previous year quarters. So somewhere I feel that just because horses are running, a pony is also running. So that's where I'm not comfortable with this stuff. Yeah.
Sir, many of the respected members and the viewers, such as Sonam Garg ma'am and Sumit Jan, have asked about the views on IT sector.
Beautiful. IT sector,
Yes, sir.
AI is the thing. AI is the new e-commerce. Unfortunately, the big players in AI are NVIDIA, AMD, Advanced Materials, Google, Meta, Amazon. They are not in India, but you can play with it very easily with the ETF called as Mafang. So for AI, I'm just not betting on any Indian company. I am betting on Mafang. The beauty of Mafang is that this is an ETF and this works on the top 10 market cap companies in US. And fortunately, NVIDIA, AMD, Amazon, your Microsoft, your Google, all are in it. You have the whole I would say the environment, the platform over there, the chip manufacturers, the higher end users and application creators, all are there in Mefang. So if you want to play with IT sector, I am working practically with Mefang. I have a small set which is working on the domestic IT sector players. But if you are working with domestic IT sector players, try to play with players who are into product, not in services. So the player who are in product is Newgen, very nice product they have. You have Persistent, you have KPIT. So these are the differentiators. When we actually, I'm revealing quite a good amount of example of the further books, but just to give you an idea. So
That's
yeah,
the generational knowledge.
yeah. So this is what is something that in IT, if you want to pursue, Mafang has a drawback. because I believe your taxation will be more in India. But when it is an ETF, you can play long term. The money that you need for your tidbits here and there, withdraw that much only. Otherwise, let it lie in MAFANG. You will find great peace over there. It is a good FD actually in the market today. Because what will happen? The 10 top players will change, but you'll be still with the top 10 players in the world. And all these are high tech companies with a great future. You cannot imagine a world today without Insta, without Facebook, without Google, without Amazon. They are there in this.
Correct. Correct, sir. We would like to take another query from Dhruv Prakash from Mumbai. He is asking if is stop loss is really stopping loss or reversal is making to lose opportunities in this AI area.
See, what happens is that you will never come to know whether a stop loss was a stop loss or a reversal. You will come to know only in the hindsight, right? So don't fall prey to this. By the law of probabilities, have a simple rule. If it is a stop loss hit, come out. Whether it will reverse or not, it's okay. I don't mind. Most of the cases I've seen that it doesn't. So I'm happy with taking stop losses. Yeah. Should I take a stop loss or not? Bankrupts people.
We have another query from Ishant Govindani from Maharashtra, who is asking, can you please guide us on how to build a trading plan and how one should build their own trading strategy?
We will come to it at the conclusion part of this session, that how we sip out the knowledge out of all these guys and make a strategy.
Definitely, sir.
Okay.
Definitely.
Yes.
Should
All
we
right.
continue?
Yeah, right. Interesting questions. Helps me to stay on my toes as I move on to the next one. So the third book that I moved on was that, okay, my dear friend Stan Winstein told me that, okay, you should get a base out here. It should track it with a 30 WMA. But then what I observed was that there are whipsaws that happen around these averages also. Like we had the you see this IRCTC. So there are whipsaws that are happening, right? I come out of this zone, I correct. I come out of this zone, and these kind of whipsaws are coming. How do I really figure out that which is a better opportunity between all these crossovers of the price with 30 WMA? This led me to understanding that what is a base. Base is particularly nothing but a consolidation zone. So you have a consolidation zone over here, right? Now this is your base from where you are coming out. So what you have to really do is that spend your time in understanding, the dynamics of price movement in this zone. And what better book than the one by the wizard himself, the Mark Minervini, to understand how do the consolidation dynamic works. So this book was very pricey when I bought it in COVID period. You can remember I've left my job and I'm spending 5K on this book. It's currently, I don't know, surprisingly available below 1K on Amazon. So if you read through this book, the most important thing I realized was what is happening in this box is something which Mark Minervini very well demystifies for you. So now we will go with his first book, that is Working with the Stock Market Wizard and Trading Like a Stock Market Wizard. So let's get on with this book. Now, in this book, what are the three important things that he works on? Mark Minervini, for his graceful part, also stresses a lot on the psychology. He talks to you that you should become very, very professional when you work in the market. This is very important. Don't take your capital for granted and one stock here and another stock there and all those kind of stuff. Don't do that harakiri. Become professional, become focused, become what I would say is really efficient in the way you work in the market. Look at nitty gritties, look at small things, but keep excelling in the market. That is what he beautifully starts off in this book also, and even that is there in his third book, right? So two things are important for you to succeed in the market. That is desire to succeed and a winning strategy. Desire to succeed is something that you should have forever. And a discipline to follow a few winning strategies is also what you need forever. Don't design new winning strategy every other day. That is not the idea here. Have a winning strategy. It works for you. It will be different for everybody. Mind you, the kind of stocks I work with, my strategies are called as turtle, tigers, and dark horses or snails. They are all spread on the different spots on the chart. Now they are designed based on what is the psychology that you would like to work with, right? So figure out what suits you. That is your winning strategy, and then have that urge to excel every day in the market. That is very, very critical. That is what will help you grow in the market. Then he moves on to a concept called as SEPA, specific entry point analysis. Now this is the thing which drew down to me to design my trading plans and design my framework. Okay, I call my framework as sleep framework. It is already discussed in many of my YouTube videos, but we'll talk about it later also. So this framework came out of his SEPA understanding that important for you to succeed in any particular stock is the overall trend. Now, this is the first guy who started talking strongly about fundamentals, the catalyst over there, then entry and a exit point. Now, out of all these things, you can digitalize the four things. Number one, you can identify trend very easily. You can identify entries very easily. You can strategize exits very easily. You can scan for good fundamentals very easily. What remains ambiguous, on which you have to work for lifelong, is finding the catalyst. Now, this is where as you improve, you go, your network improves. Many of you guys are already CAs, you might be having very strong network. You might get a catalyst sooner than me, but sitting in this corner of my world over here, at times I struggle to get a catalyst, which is okay. Down the line, I figure it out. The stock is moving, I ride. But all these four parameters, I am going to exceptionally pick it up based on simple, pure numbers. Okay. Then the question that was high P should not block your way. High P should not block your way, right? Why you should not be bothered is because if you're good at technical analysis, what will happen? You will start your journey at a base. Market is not concerned about the P, you will find the stock going up. The moment market is concerned about the P, you will get a correction. And what will happen? My dear friend, my exit will trigger. I will come out. That is the beauty. If you combine technical analysis with fundamental analysis, you don't need to really work hard on fundamental analysis. Frankly telling you, doing 6-7 ratio analysis, you get a good stock. Doing some trend analysis on earnings, sales, and margins, you get a good stock. After that, don't look at cash flow thing. I don't look at it, frankly. I don't advise you, but I skip on that. I skip on promoter's profile. He's from IIM and what all he has done before. I skip on getting into what is the breakdown of his borrowings and all those things. I really do not care about it. Why? Because if I do that hard work, what is going to happen is that my 80% decision is made out of those ratios very well. Petrosky score, simple thing, 80% decision is done. 20% remaining is out of all that nitty gritty analysis. But for this 20%, my effort in fundamental analysis goes up to 80%. I can quickly do this analysis within 20% of effort, but for getting this 20% correct, I have to increase my effort to 80%. I do not agree for it. What I do is that I use my technical analysis to catch up the goof up. If any goof happens, you what beauty Mark Minerva says here that what really matters for you to spot a good stock in fundamentals is code 33. Growth, earnings growth, stable and growing margin. Till the time you have this, Mark Minervini's theory says that it works. Okay. Then Mark Minervini also talks about the 4 cycles. Now these guys change the names just to create originality, maybe. The neglect, advancing. So you have the accumulation phase, you have the running phase, the distribution phase, and the breakdown phase, right? So this is what are the 4 phases that you get. And in the price action, he strongly recommends this particular pattern, called it as a VCP pattern, volatility contraction pattern. And this is something which is actually ascending triangle breakout in the old times. So same old wine in a new bottle, he named it as a volatility contraction patterns, and that works very successfully. And even I have observed it works very successfully. But one thing he hasn't mentioned in this book, which I have figured it out through my own real life experiences, so I've adjusted those strategies for myself. But at a ground zero level, yes, beautifully he has explained how the price action works. Then manage your risk well. Strict stop losses and regular profit booking is something that he recommends. So these are his key mantras. And what works mainly for him are this stage analysis, what I told you, and these patterns. The more the waves you have, the stronger the probability of a good run up is, because more time you spend below the resistance, right? So this is what is the basic course summary. I would pick up the VCP pattern, how it is created, and then the code 33. These are the two main crux that I pulled out of his book. Okay. And now his psychologically also he sells is that most important part, be strict on your stop loss and selling into strength. He's not a guy to let you go away easy. He stresses a lot on stop losses. And it really comes out like a real trader who has done it onto the field, that he has seen his capital getting booked out many times, wiped out many times. So stop losses are very, very critical. Stick to your plan under all conditions. No need to trade every day, every time. And this is where he mentions sit on cash. He is very much active on Twitter. You will find many times he mentions that he is not working in the market when the US market is in a downtrend. So this is something that also comes out of his book. Okay. Now, where I will spend next 15-20 minutes will be how his dynamics around the breakout setup works. Okay. This is a very small section that I can discuss with the time we have, but I'll still bring it out in front of you. You can work out on further details as we move on. So by his concept, the breakout happens because of two things. One, demand. There should be a strong demand of the stock, and the supply. So if you want the prices to run up, your demand should be running high and your supply should be running low. Okay, basic of economics. Now, very smartly, he defines demand as excitement of the buyer and supply as the absence of the seller. So you are going to have a breakout which will flare up only if the sellers are out and the buyers are excited. Okay. Now we'll figure out how on the chart we can say that the sellers are absent or sellers are getting negligible on the chart. So for this, what we have to do, we have to really take out a breakout stock which is coming out of a zone and start looking at its pattern. So if you have a stock which is having a longer duration of resistance, higher chances that seller would have booked out. The short-term players, as the price touches this resistance, what they will say, oh, I'm getting my price, let me book out. I'm getting my price, let me book out. So this retailers, which are the weak hands, the sellers who sell very promptly, they get out of the stock the more the time this resistance is touched. So for the resistance to touch more times, definitely the duration of this resistance should be very, very high. That will push out the seller. Number two, higher the selling waves, that is also good. More the selling waves, the better it is, because that many times you are prompted to sell. So if that many times you are prompted to sell, high chances that you are exiting from the stock. Like I'll give you a very quick example about it. This is the stock on the long-term chart of Deepak Nitrite. Okay, right. So Deepak Nitrite, if I put it for 3 years weekly, let me put it on 50 MA. I'll just move out the MA model. Okay. Now here on the Deepak Nitrite, can you see this resistance? It is surviving for how long? Yeah, this is a beautiful volatility contraction. Why? because you can see earlier it went very deep, then it went lesser deep, then it is going lesser deep. So this is called as volatility is contracting. Your swings from your resistance is reducing, right? And this is what makes up for his volatility contraction pattern. So number one thing, your resistance should survive long. Number two, you should have minimum three or more waves. Beautiful. This resistance, by the way, is surviving for around 2 years. My dear friend, great opportunity. 2 years resistance has survived. Three, four waves have come. Sellers have been kicked out. Third way to figure out that your seller is absent. Number one, duration. Number two, multiple waves. Number three is that your volume on the right side on selling days should reduce. So you see, initial part of the fall, sellers are dominant. You see more red color. बहुत खून खराब है ना इधर, right? This tells you that sellers are active. Now here it is drying out. Stock is falling with low volume. So that tells you seller is out. So these are the three ways by which you figure out the seller is out. Now let's look at how will I figure out my buyer is excited. Again, three things will tell you that buyer is excited. Number one thing that tells you buyer is excited is that overall fall in the stock prices should be small. So if you see over here, we were at 2300 as my resistance. The bottommost point I went was 1700. 2300 to 1700 will make it around 600, right? So 600 on a 2300 is around 20, 30, 25 to 30%. 23 twice 46, 46 and 23 will make it 690, right? So 2300 to 1700, actually I am within 25%. So I am within 25% for a 2 year period itself tells you that बात में कुछ तो दम है, ये गिरा नहीं. So there is something cooking over here. So number one, overall fall is less. Number two, you'll observe that buyer is getting excited by looking at the bottoms. If the bottoms are rising, that tells you that buyer का impatience बढ़ रहा है. Buyer is getting impatient. That you can spot very, very easily, right? So this is how you get to this is where you will understand VCP. Why VCP is important? It is telling you that buyer is getting impatient. He is getting excited. नीचे नीचे ऊपर ऊपर घाई हो रहा है. He is getting into a rush, and that will cause a breakout. Okay. Third thing which tells me that buyer is excited. Look at the volume. Earlier on, buying was less, intermittent with the selling, but now it is more buying days, more good volume coming up. So these are the signs which tell you that yes, stock is going to give a good VCP breakout. Another brilliant long-term stock, huh? You will be surprised on the monthly chart also we get a VCP. My good friend on monthly chart who is giving a VCP is Asian Paints. You see the VCP on Asian Paints, this is on the monthly chart, my dear friend. Now you can see over here the swings and all that getting tightened, and we have made three waves already. This was my first swing, this was my second swing, so I came up a bit, and third swing is much near, right? And you know that fuel prices are going to cut. All things are there known to the market, and this is an Asian Paints lambi race ka ghoda, long term good business, a very much evolving business trying to diversify to beat the competition. It is giving you a VCP. So this is how the core concept around the VCP that settled down with me, and that is what I learned mainly from Mark Meneveni. What I learned was the aggression. Be very strict with yourself. Whatever happens, your money should give you money. If your money is getting lost, come out. No emotions, nothing. What matters is that you have ammunition left to fire next lob, right? You should always have money in your hand. Don't give it much to any stock. Just buy at the right point, exit if the story gets spoiled quickly, and when you run, try to even sell in strength. He sells in strength also. Frankly, I don't do that. I don't do that because I feel that it might still go up. So my mentality is still not suitable for selling in strength. I sell on a bit of weakness. You can think about it. If you want selling on strength, many of my students, many of my friends do it. It works either ways, right? Whatever there works for you, do it.
We would
Okay.
like to take one question regarding this topic only. from Sandeep Kumar Jaiswal of Delhi. He's asking, is there any particular time from 9:30 to 3:30 when you will suggest to avoid to take any trade?
Yeah, I'll tell you. Look into the postulates that Dove's theory gives you. Dove's theory gives you some 9 to 11 points. So at one point, Charles Dove says that my closing price is sacred. My closing price is sacred. So whatever time frame you are working on, try to work near the closing time, because that is where other guys who are working on your time frame are taking their general decisions. Okay. So if you are a guy who is going to work on a daily chart, work between 2:30 to 3:30. I run my scanners for buy at 10:30, 11:30, and for selling at 2:30. Buy at 10:30. Why? Because sometime intraday itself the stock can get stretched. So I can take my buy decisions around 10:30, 11. Partial quantity I buy it. 2:30 it confirms my strength. I buy further quantity. And for selling, I definitely give the opportunity for the stock, if it is hitting my stop loss, to come and really close below the averages at 2:30. Yeah, that is a discipline that I follow. Many times, because intraday spikes, I don't want to lose my stock. I never put a GTT order, by the way. I never do it. Yeah. Anybody, any question?
Yes, sir. There are few more questions. One question from Mohammad Fakhrul Hassan of Muzaffarpur. He is asking, what is the strategy that you would suggest if a person is about to start his journey of investing?
The strategy which I call it as turtles, trend following. Trend following is better for a new player in the market. Yeah. Where you enter a bit before the breakout itself. So that is where I would suggest trend following is a better strategy for a newcomer. Breakout strategy, the downside of breakout strategy is the moment stock breaks out, no, volatility increases, and that panics. That creates a panics. And for a newcomer, it is like getting into the water and the water gets into your nose immediately. So start shallow at a trend following strategy. You will be entering before the breakout. By God's grace, if the breakout comes, the volatility will be above your buying price. Till the time the stock is in green, you're always not worried. The moment that volatility makes it red, you start doubting. So that's why, as a newcomer, I would always suggest, I call it as the turtle strategy. The trend following is better.
Following the next question is from Roshan Kumar Jha of New Delhi. What is the role of shareholding pattern while considering a stock?
Uh, when we will discuss canceling also with the next book, I will explain you the shareholding pattern, what way it affects.
Definitely, sir.
Right?
With this,
All
we
done?
would like to move to your suggestion, sir.
Yeah. Can I move to the next one?
Definitely, sir.
Okay. So that covers, I am running at around 1 hour left. How much time do you need at the end to close? I don't know. That's why I'm asking.
That would be around 10 minutes.
Okay. So I have 50 minutes. So ये 50 मिनट मुझसे कोई छीन नहीं सकता. So let me do the best out of it.
Definitely, sir. That belongs to you.
So, so this is what Mark Minervini really taught me. What I would suggest you should focus with Mark Minervini is number one, be highly professional. I call it ruthless when you are in the market. Be ruthless, be brutal when you have to exit. Be brutal. I say it in the slang, no? अगर मेरे सिस्टम ने सिग्नल दे दिया तो मैं खुद की भी नहीं सुनता. That is very important. Don't even hear what your heart is saying when the signal comes. Out means out. Nothing doing. Tomorrow, don't look back and regret. It's okay. It broke my system. I came out. I did well. I did well. Market played its tricks. That's okay. But I didn't mess it up. Okay. Number two is, going with the SEO model. He calls his code 333, but difficult to remember. So I remember it as a SEO model. Sales should be growing, earnings should be growing, margins should be growing or stable, right? That is on the fundamentals that he mentioned. And thirdly, definitely understanding the price action dynamics, which I showed you here. You see, the beauty of the way Mr. Mark Miner, when he explains, is that he doesn't talk about candlestick shapes at all in this. I love that. If he starts talking about you should have a hammer and you should have a engulfing, and I cannot take it. But this guy does it beautifully well. He talks in terms of the swings that you're having, and very well. It when the market really works for the smart guy, my trend following guy, he will enter here itself. That is the beauty. If you see a stock is making the third wave and you see it is getting ripe for an entry, यहीं पे entry कर लेते हैं ना, right? Why to wait for this breakout? And this is where I use my turtle strategy. And that is what it really works out well. Now, these are some modifications that beyond books, somebody asked me that how do I go? So beyond books, this is how I would go, like Olectra Green, right? Yeah, I'll show you how we just went into it recently. Okay. So Olectra Green, we put up our averages, say 200. Okay. Now you see over here, Olectra Green, where is my resistance? My strategy will tell me that here is your resistance, my dear friend. And then what does my strategy tells me? My dear friend, we made so many touches here. So this is a ripe fruit. Huh? This is a ripe for breakout. Yeah. Then what I look at is this wave. Now this way it is reversing. So this wave is my fourth or fifth wave. Means I am near the breakout. Once I am above two waves, means I am above two waves, third, fourth, fifth onwards, the probability is high of a breakout. And you can see the swings are getting closer and closer. A VCP is getting formed. Now, this is where my turtle strategy would make an entry over here and here itself, rather than waiting here. Because now what will happen? This all breakout came because of the news of the bus and all that. And on Monday, looking at the US market in red, I don't know whether how people will behave here, but I am quite comfortable because my stop loss is now much deeper than what I would have on this day. So my stop loss being much deeper actually puts me in line with over here the smallest, the deepest it went in the structure. So my probability of surviving and running up is higher. Getting my point? And if you see, when I entered here, there is no pattern of volume. There is no pattern of volume. So in such cases, that is where you have to do jugards from what the book is saying to get some smart thing done to satisfy your psychology. I am not comfortable here with the volatility, so I'm going to enter before. So I may not have volume support, but then I have done my calculation. Number of waves are more, so good enough. So this is what the Mark Minervini book really gave me. Understanding the price structure well, the SEO model, and being thoroughbred. What I call it as uh, the guy who is really ruthless with his strategies. Got it? So that covers my third book. Now we'll come to the fourth book. This book is the masterpiece. Out of all my fourth book, all my books, this is the book that I read really later. Really later, I read it. And why I really read it later, if you open this book, till page around 111, it just shows you charts after charts. Till 111, it just kept on showing me charts after chart. It got me a bit disinterested. And then the year 2022 came. Now 2022 came and I started losing money in the market. In 2021, we were in a trend. Hey Gango, idhar maro, udhar lag gaya, udhar maro, udhar lag gaya. I am an expert, I am a guru. That confidence came, but 2020 really shook me off. Now, when it shook me off, I was wondering why the heck the strategy is not working. And then somehow I survived myself. Somehow I survived myself through the first 111 pages. Then let me tell you the pages from which the story really evolves. So if you're reading this book by William O'Neill, How to Make Money in Stock Market, start reading from page around 152. Okay. Start reading from 152 or even 110 is fine. So if you start reading from 100 till 110 till 199, you could get through a lot of learning from this book. So that is where my fourth book came into the picture. Now I'll be a bit faster because we have just 45 minutes left, but I think that will be sufficient. So now if you look at this book, what are the key learnings that this book gave me? This book really stresses on learn to read the charts. So he also talks like Mark Minervini, like Stan Weinstein. By the way, these all guys refer to each other. Huh? And as the book comes on the timeline, so Mark Minervini quotes William O'Neill. Mark Minervini also quotes Stan Weinstein, by the way. And William O'Neill also at times quotes Stan Weinstein. So these guys are really talking around same concept, and it works. That assures you it works, right? Then he tells that you should definitely look at the charts for making your buy sell decisions. You should use the CanSlim framework to pick the stocks. If you ask me, the best Technofunda framework in the world I've ever seen is this CanSlim framework. Super powerful. We will talk about it. This is a game changer, by the way. Okay, because out of all the authors, I find this is the guy who really balanced it up well between technical and fundamental without too much of noise, just from 110 pages till 200. So within 90 pages he could do it. That's the beauty of the work he did. Selling at right time is very important. Do not wait for recovery and all that pain. Keep it simple. Exit. The trend breaks. Exit. Weakness comes. Exit. And if you're funda follower, if the results come back, exit. Okay. You don't win big in the market by being right all the time, but by losing the least amount of money when you are wrong. This is something you'll find another quote, I believe, is by the another good author, which I have read about is uh, Lynch, Peter Lynch. So there is another quote that is that water your flowers and cut your weeds. So if you have winners, let them go up, up, up. Okay. But if you are losing, exit at the least amount that you can. That is very, very critical. Because what happens if you see logically, if you are sitting on a probability game where your success rate is even 50-50%, what happens is that you'll end up in profit by doing this, because at 10% you keep exiting, but you create and trail your winners for 30%, 50%, 100%. So the overall winners will compensate for the losers also. Even if the probability is bit distorted, you still do not lose money in the market. So this theory is very, very important. Accept that you will make mistakes in the stock selection. Very important psychological part. Accept, yeah, it's okay. Market may there are tons of variables. Tomorrow morning, what announcement will come? Tomorrow mornings, who is going to shoot the next missile? I don't know. It is going to happen someday, somewhere. It is going to happen. It is going to cause my market to crash. Accept it. That's okay. Be calculated with your risk. You found the best setup. You found the best fundamentals. You did what was best. After that, leave the rest. If it follows your probability line, trade it, trail it, trail it. If it doesn't, exit sooner. Do not haggle with it. Okay. More so if you are working with a sector which is in trend, market which is in trend, most of the time you will get a bounce because the whole sale is aligned to you, right? Most of the time you'll get a bounce. But in case it doesn't, it's that bad probability that happened. You have to just exit it without any regrets. That's very, very critical, right? Now, key things that we pull off from this book are number one, technical analysis is very critical to achieve good winning rate. Market and sectoral trends should be supportive. Who told this first? Stan Weinstein. Who told it next time? Mark Minervini. Mr. William O'Neill also talks about the same thing. Again, he repeats what Mark Minervini says. High P should not be a stopper. Trail it. Because the story becomes good, they start even tracking and discounting the future earnings, right? 2-3 quarters ahead, sometime a year ahead, they start discounting. They know that this P is nothing. It will come under control with the new earnings, because P's formula kya hai? Price upon earnings, right? Price upon earning. So this is simple. If your earnings are going to fall in line, the P by E is again going to get under control. So many times we cannot fathom it. Yeah? So just live with it. Put your stop losses and trail it. If the big player exits, he thinks it is pricey, we will also exit. Simple way. For achieving higher success rate, focus on businesses. This is beautiful, huh? Businesses with earnings growth, doing something new. This is what Mark Minervini called as a catalyst. Okay, Mark Minervini calls as a catalyst. Then work with the leaders in their domain. high promoter and institutional presence. High promoter is another thing you'll find in another book. I haven't talked about it here. Is the 100 Baggers. If you read that book, skin in the game is something that they look for. They look for promoters with higher stakes. So typically, looking for stocks with 50% plus stakes is very, very good. Below that, yeah, it becomes a bit dicey. Institutional presence is something which I find is bit shaky between the major players, because William O'Neill says that institutional presence should be there, and Peter Lynch says that identify the stock before the institutions get in, because institutions will make it run and get it better for you. So there is a bit of ambiguity. For me, what I really look for is this bucket. This is something which people don't talk. The bucket of public holding should be small. Basically, what I want is less weak hands. Where is the less weak hands? The public holding. Now, if the public holding is less than 25%, let that 75% go with promoter, DII, FII. I don't care. Simple thing is that look for that low public holding. Some tricks, looking at data in a different manner and not losing the big picture. So, what really causes promoter high holding and all that is skin in the game? But my dear friend, what makes the stock runs? When the stock is in shortage, when the public is having less holding. So why do we look at promoter and FIDI? Look at lower public holding. You'll get a different picture. Okay. Then yes, stop loss. Now stop loss. William O'Neill really talks about 7 to 8% stop loss. Mind you, William O'Neill is working on a daily time frame. So daily time frame, 7 to 8% is the stop loss he looks at. If you are working on weekly, just proportionate it. Typically for a weekly, you can go up to 15 to 20%. My experience, okay? No recommendation. You can figure it out as per your psychology. Selling at right time is a must. Same thing you heard from Mark Minervini. Weakening of trend, high volume selling, climax stops, and gap ups at the peak. Now, these are something where they say that you should be exiting, okay? Which is like selling in the strength, actually, right? So, these are the key inputs that came from this book, and these are the key learnings I got. Now, thankfully, I still have half an hour to go, so I can spend more time with you on a very important concept that comes out of that book, and that is this concept of canceling. So now let's look at it, how Technofunda really works for us in the market. So if you're looking at fundamental parts within the canceling, what are fundamentals? What are fundamental relevant numbers here? C is fundamental, A is fundamental, N is fundamental, S is technical. Okay. L is fundamental, institutional ownership is fundamental, market direction is technical. So if you look at it, within the canceling model that he suggests, two parameters are technical, rest are fundamentals. Okay, how the story grows from here, let me explain it to you. So if you really want to pick up a good solid stock, make sure that its current quarterly earnings are growing. That is, current quarter is, suppose I take Q0 versus the Q minus 1, my earnings should be growing. Annual earnings. Now, there are two ways to look at it. One is the trailing 12 months TTM profit growth that you get as profit growth in Screener, or you can also look at my current quarter versus the previous year's quarter, same quarter of the previous year. Both ways you can look at it. Look both ways, better. I do both ways. The current quarter to previous quarter, it should go. Current quarter to previous year quarter, it should grow. Overall trailing 12 months, it should growth. Growth is very much necessary, because price chases earnings. So earnings should grow. Definitely it should grow. If the stock is running and earnings are not growing, there are two things. Either it is a turnaround story. Number two, there's an operator into it. So I don't want to work on turnaround stories. I'm fine. Tata bye bye balle balle. I'm not that brilliant. I agree. That is not my strength. So I just look at this thing should be there. Andha aadmi hai, ye chahiye mere ko. Okay. Then look at supply and demand. Now, this is where I told you number one thing, work with a small cap or mid cap. You immediately shrink the quantity of, oh, I missed on the N. Sorry, I'll come at N later. So, supply and demand. First thing, work at a small cap or a mid cap. Automatically, the number of quantity of stocks in float is less. Okay. Number two, add it up with the poor public holding. So promoter holding is high, DI holding is high. So your public holding should be low. Now what happens? You selected a stock already in shortage, public holding become hai. Now the game begins. Now if there is a bit of fire, no, this grass is very, very dry. A bit of fire and it boom, it will go up. That is what is supply and demand. Then the third concept in supply and demand, now, this is where you should look for price patterns. So, William O'Neill talks about only cup and handle, by the way. Okay. We can top it up with what Mark Minervini says with VCP. So, on the chart, you get these patterns. This also tells you that supply is less, demand is going to be high, plus okay, sorry. Then small cap, mid cap with a poor public holding, less float, you have a dry grass. It can flare up. Got it? So that is supply and demand. A big reason for demand is the growth. Okay, big reason for demand is growth. Then the stock should be leader in its sector. It should be. Now this is where I'll combine the N and L. N and L is basically the company should be doing something new, and it should have a dominant status in the market, dominant presence, monopolistic, duopolistic. If you have that kind of a stock into high-tech industry, into highly researched product, into innovative product, good to go. Electra Green, a duopolistic kind of a business, always evolving their products. Okay. HBL Power. HBL Power is linked to two hot sectors today: railways plus defense. Beauty. Railways, you got this guy related to even your defense, plus this guy will come into green energy also because he's expert in battery. Got it? These guys have developed their own anti-collision system, which is getting implemented in India at one sector. And remember, there are 100 plus sectors in India. Then India is talking about exporting its stuff. Definitely, this government will push that even our railway technologies be exported. Another big opportunity for HBL Power. So they are into innovative product, practically a monopoly in the anti-crash systems over there. It's not easy to get through the government machinery and prove trials and get your product ready to implement. Think about they call it as the moat. Think about the challenge for other partners or competitors to enter. This is the N and L for you. This is the N and L for you, right? You look at Avental, great, innovative, R&D oriented business. Zen Technologies, great, totally innovative business. You know, Zen Technology used to work for Hyderabad police for making simulation stuff for police. From that simulation, they went into simulating for army for their firing ranges, for fighter planes. From there, they went to remote sensors for the your drones. Now, drones are a big threat in the world, and these guys are able to sense where the drone is and try to build those technologies. Now, this is where your innovations and being leader comes into. Another great stock that we picked up just last week was Shriram Piston. The name Piston tells you that, oh, this is a dying technology with the battery and EV thing coming. But deep dive into their AR annual report, you'll find they are doing a lot of innovative stuff. And this is where I show you the real example how it flares up. Okay. Then institutional ownership, I told you, FIDI presence and smaller presence of the public. Now this and then the market should be an uptrend. Everything will work if the whole there is no snowfall. There is a dry grass, it will catch up fire, but if there is a snowfall, the fire is not going to spread, my dear friend. It is going to get stuck up. So the big boss should be always in a mood. Shakal should be, or you call it the Mogambo should be in the mood. If the Mogambo is in the mood, then the music will play. If the DJ is playing the music, then the dance will go. So make sure that market is in uptrend, sector is in uptrend, and then look for quarterly growth, annual growth, look for innovative product, leadership role, monopolistic business. And on the setups, look for VCPs, look for cup and handles, look for 30 WMA. I think you got the recipe that I am bringing to you. Anybody, any question over here, please?
Definitely, sir. There are few questions, and the questions itself shows that you are pretty well explained to the retail investors, the viewers. Every single point has been covered. Sir, there is one question from Nandakumar PA from Kochi, who is asking, please suggest some good books for option trading.
I surrender there. I surrender option trading. Why? I'll tell you the reason. It's personal. I'm not against anybody who is successful in options, but I am not successful. The main reason is that there are too many moving components and they are very short-lived. There are spikes coming every day and destroying the algos and all that I can see with my bare eyes. There are 5 expiries every day. There are some stocks which can hit multiple indices together, like HDFC Bank. They are being played around. So you have a VCP getting built up on a 5-minute chart, but the stock goes down, makes a big, huge candle, then it comes up again. So I frankly believe options are getting manipulated and intentionally they are being allowed to be done so. That is what my understanding is. I'm not really blaming anybody, but I'm cautioning the retailers that if you get into options, make sure that you protect your capital a lot.
Yes.
If you're failing, accept it sooner rather than getting swayed by YouTube videos and all those claims that are being made by big players. Do options because for them it is hedging. But for you, if you're looking option as one way tool to make money, the overall maths doesn't work around you. And if the odds are against you, I would never get into that field. So options definitely through books.
Says that 9 out of 10 individuals loses their money in option trading.
And remember that all brokerages make big money out of the brokerages come from options.
Yes.
So this ecosystem, I will not speak more. You should understand.
Yes, sir. Another question from Nitish Kumar Jaiswal from Patna, who is asking, sir, whether moving average is working in intraday trading?
They work on intraday trading. They do work. But again, I'm cautioning you, the more the short term you go, more the operators can easily play with you. More the operators, because थोड़ा पैसा लगेगा धक्का मारने के लिए, थोड़ा वॉल्यूम लगेगा धक्का मारने के लिए. So whenever you go intraday, your strategies will again start having higher rate of failure because manipulation is pretty easy. When you go on higher time frames, you need more money, you need more stock to play around with things, and there manipulation starts becoming difficult.
Another question from Raj Gopal Bhutada of Bangalore. How do you explain the rise in stocks like SJVN, South Indian Bank, or Ircon by charts? The rise was huge and quick.
Yeah, see, the thing is that you have to enter at the setup and then look at the catalyst. So the catalyst, what I think South Indian Bank has was the management change, the new leadership. So that brought around the turnaround. SGVN, the catalyst was they are moving into green energy very strongly. Government changed their profile itself. Government changed their RNR itself, the scope itself. And that is where the catalyst worked. So look at the catalyst. If the catalyst is present, either the management change or regulatory change or the change in the approach, change in the product range, you would get swift moves.
Definitely, sir. We have one request from Regan Kapoor of Sonipat, who is asking to suggest the strategies for IPO investments. or the books that can be referred for understanding the IPOs?
IPO, I don't work. You should watch a small clip by William O'Neill. William O'Neill says that don't tell me any story. You will not be able to sell me if there is no quarterly growth. So, in case of an IPO, whatever data you see is actually before the company got listed. So,
Yes.
regulatory norms and other things are not that strict. Many times you'll observe post listing, first result is great. Next result onwards, the skeleton starts falling down. So, for me, IPO, frankly, I don't play because number one, probability of getting it is less. Number two, if you get it also, it is a small chunk. It is a small chunk. Even if it doubles, doesn't make any sense to me. And thirdly, I want to stay focused. So I stay focused in the secondary market and I work around with it. IPOs I intentionally skip because वो फॉर्म भरो फिर उसका इंतजार करो, you get a small quantity. It doubles up also doesn't make a big difference to me. So practically I stay away from IPOs. And another thing I'll tell you, IPOs is a big game by VCs to pass the buck onto the retailers. Look at what happened with Zomato. Look at what happened with Nykaa. Look at what happened with Paytm. You should understand the whole ecosystem starts beating the drum. Beautiful company, great business, high tech, so many transactions happening every day. That is the way the IPO is pumped up. And who gets out? The VCs gets out. So this is a VC's game that gung ho, and they taken their exit, and finally the dead bodies are left with the retailers. Frankly, my individual personal view, and that's why I don't work into IPOs. Yep. I let the stock settle in, build up the structure, show its performance on quarterly basis. Then I'll start taking entries. It's better to be safe late than sorry.
Yes, as correctly said, that it's better to wait than to regret.
And in IPO, you don't have a moving average, right? My big friend is not there.
Yes.
How can I work?
Yes, sir. And I would like to put short canceling into what I have understood, that four P's has to be considered for making the understanding of any share. That is the first one being people, the people running the management, or the people who are the leaders of the company, the profit that has to be taken care, because that is one of the components that the price of the share will depend. The product, it has to be the innovative one to have the economic moat settled for any of the investor, and of course the public shareholding.
There's one correction. Maybe you consider these leaders as the leadership team. That's not the case, huh? This is basically a company, a business should be monopolistic or duopolistic. So leader in the market. That's only correction I want.
Definitely, sir. Definitely.
Yep. Got it. Any other question you have on the board?
No, sir.
Oh,
The
great.
lesson number question itself shows that you are very clear with the presentations and with the lessons that you are going to give away to us.
Great. Or people are tired after 2.5 hours.
No, sir,
Anyway,
definitely not.
let's get on to what I call it as the mandatory overs. So after all these books that I have read, I have also read a book by Peter Lynch, One Upon Wall Street. So if you read the book by Peter Lynch, One Upon Wall Street, I didn't bring it up because of shortage of time. He mentions there are 6 categories of businesses that are there in the market. His categories are different. I have pulled out a gist from it. So typically, if you look at it into the market in terms of earnings, if you see businesses are of different 4 types. Number one, businesses which are ever growing or which have a long-term cycle. So these are businesses like railways, defense today, green energy, power sector. They are actually going to run 3+ year, right? So being in this stock is good because if you get a rally, the trend is going to survive for a longer duration. Okay. You should always avoid cyclical businesses like the metals, the commodities, right? They fluctuate with the rates, right? And then the seasonal businesses like the agri businesses, like the marriage season businesses like Vedanta and all that. Because what happens quarter to quarter, the earnings will go up and swing down, go up and swing down, and that is what you will see as a volatility in the prices also. Okay. I am telling you how to cut down the focus zone really of the kind of businesses that you should look for. Avoid cyclicals. I avoid fertilizers. I avoid sugars. Uh, I avoid the Vedanta marriage religion related stuff. Then even metals, I avoid the core uh, raw metals basically. But I definitely go for alloys. Like you'll have a one good company which is around the alloys is Shivalik Bimetal. Now that is an ever growing thing because they have a very unique shunt technology, shunt developing an alloy that they develop, which is highly used in electronic meters and green energies, EVs, right? So that is fine because you are getting something which is of a higher order. So that is fine. Okay. That is going to increase your margins. So we are fine with it. But no seasonals for me and no deep growing businesses. The degrowing businesses, the big examples are pizza. Pizza now you are getting into every nook and corner of the city. And this is where you will find that Jubilant is going to struggle because earlier it was a unique idea, but now it is falling off. So avoid degrowing businesses, avoid seasonal businesses, avoid cyclicals, focus on ever growing businesses only. That is something you can read more from the book by Peter Lynch, One Upon Wall Street. But this is very critical because this has changed my results in the market a lot. Yeah. Okay. Now, coming on to the last 15 minutes, how did I build my strategy? So the moment I went through these books, I realized that 5 things I need to focus to make money in the market: selection of stocks that can be done fundamentally as well as technically, level-headed mindset, psychology, follow your rules ruthlessly, shamelessly. I'm very shameless to come and say that my stop loss is it. पैसा नहीं जा you know इज्जत गया तो चलेगा लेकिन पैसा नहीं जाना चाहिए मार्केट में. You lose your name and fame, it is okay, but just sticking to your ego that I was right, don't lose your money. It's okay, let it go. Mark, the stock is not showing trend, it's fine, let it go. Entry timing is crucial, exit timing is crucial, and finally portfolio sizing. Load your stocks with a considerable good amount of distributed bets. That is where you'll have good risk management a lot that goes through the portfolio sizing. So this is how the sleep framework really came into being for me. And today I'm running multiple strategies around it, like the trend following, I call it as turtles, the breakouts, which I call it as tigers, the bottom real value investing and all that, I call it as snails. Then bottom fishing is also coming out of. So all these strategies, if you see, they will have this 5 parameters with scanners for entry, scanners for exit, scanners for stock selection. Okay, and a clear cut strategy of portfolio sizing. I would have 20 stocks, 30 stocks, equal weighted, that I can decide based on my risk appetite. And if I follow all these rules under all market condition, I am done with the psychological part also. So sleep framework is something whenever you are going to design your strategy, wait on these 5 things. They should be clean and clear. And that is what makes your trade plan. Got it?
Yes, sir.
Yeah.
So, with this, I would like to take another question of K. Aditya Dutt from Hyderabad, who asked whether any tools to identify on entry and exit points.
Yeah, you can use definitely the charting tools that you have. The charting has a very good ability to create scanners. So whenever you go into the charting, you can go to the create scans, or you can go to the scans, and here you can build the scanners over here. Like for you, I'll build up a very simple scanner which is based on what uh, is coming out of the 30 WMA. So we'll have a simple strategy that my entries are my weekly close. Basically, I'll be a bit fast here because of lack of time. You guys can slow it down when you play it on the recorded videos. As crosses above, I can have this crosses above my moving average, that is simple moving average. Since I'm considering weekly, it becomes WMA and I make it as 30. Okay. So if I pull it off over here, right, what all things do I really check? So whenever I pull it off over here, the stock list will come. Okay. Now stock list is coming over here. Now I'll try to figure out where the fundamentals are typically good amongst these stocks. Okay, so there are, my dear friend, around 69 stocks. So on a weekly basis they come here, but typically you can browse, and more time you spend, you can figure out which of the stocks can be good over here. Like for me, Ashok Leyland would be a good one. Let's look at it onto the fundamentals, what it is doing. So if I look at Ashok Leyland, okay, I'll go with the 3 years. So look for charts with 3 years weekly, and put your MA at 30. Okay. So here on the chart, you can observe that one thing very good, stock is taking support at 30. You can see stock is taking support at 30 WMA. So one thing is good. My fellow is good friend is working well with 30 WMA, right? Now I'll go and look at fundamentals. Okay. This is a large cap stock. As an example, I'm taking, I'll come to a bit of historical cases that I identified recently. Now let's look at its growth trends. Okay. So let's look at its growth trend, my dear friends. Profit growth is good. Okay. Quarter on quarter, how is the growth? So previous quarter wise, I've shrunk, but previous year wise, I'm good. Okay. And then promoter holding is 51%. Public holding is very small. But the problem here is it is a large cap. So even if you have this guy, he's going to poodle paddle and struggle a bit over here. But positives about this, these guys are getting into EV. Plus, these guys are getting into hydrogen, and they are also strongly in CNG. Now, these are the things that you can study. And how is the auto sector running? How is the auto sector running? So just come to the auto sector chart. So you can, this is the problem nowadays. It opens the chart in the new format, which I am not comfortable. Okay, let me show the chart. So if you look at the auto sector, how it is running. So for that, we will look at the Nifty Auto, or you can look at even CNX. Sometime it comes as CNX, but we are lucky. It is auto sector, and you can look at on the daily charts also. How is it going? It is just going up, up, up. So there is a good anomaly. You are having sector going up. You are having the stock being good one in that particular sector, in that particular theme, but is crossing at 30 WMA. So you are at an efficient point of entry. Okay. Now let's look at what Mark Minervini will do. He will come and look at the daily charts, 6 months daily. Okay. And here you can find which is the pattern over here, my dear friend, you are getting. You are about to get an inverted head and shoulder pattern over here. If you look at it, you're about to get a inverted head and shoulder pattern over here, which is a good sign. You got a volume also. Okay. Have you got a breakout? Not yet, but I can take my safe entry because I'm tracking the weekly chart. So on Monday, I'm going to plan my entries. And if I look at the fundamentals, yes, let's look at the fundamentals on the quarterly basis. So you can observe the stock is really at the correction level, but if you look at it, its sales are the second best quarter that they had. Okay. And here is the use of cyclicals you can do. Look here in March, the sales are highest. Look here in March, the sales are highest. Look here in March, the sales are highest. So there is an impact of cyclicality over here. So March results are typically higher. So even this being lower than March is not a worry to me because annually I am doing fine. Annually, if you see every annual, apart from the COVID period, the company has been growing. So I've got a stock which is growing. Okay. And if you look at it again, this is the second best quarterly earnings that they have got. So you've got the second best quarterly earnings that are there and which are reasonably fine. And then if you look at the P by E valuations, see, you are at a average of 5 year. So P by E wise also you are safe. So you have a stock which is growing near a support and P by E valuation wise safe. And let's look at the your shareholding pattern. So you see FIs have entered, DIs have exited, but I feel there is a bit of balancing that would have happened here. These are just numbers getting shifted. Otherwise, you can see overall the public holding has increased a bit. So nothing of concern over here. Only concern is that this stock is now a large cap. So it will go slow. But yes, the case that I wanted to make is that now what you have done a technical analysis. You figured out the stock through your scan of the 30 WMA. You figured out by Stan Weinstein the pattern. You have figured out it is bouncing on the average, and you have figured out a CAN slim that this is running around the CAN slim lines other than the supply part because it is a large cap. Okay. Now let me get you very interesting story, a week behind. Okay, a week or two behind I'll take you. So let's go to 3 years chart of this darling nowadays. Two monopolistic stock which came out of 30 weeks moving average. One was IEX. Monopolistic stock because these are the guys who are managing the exchange per power sector coming out of 30 WA at such a base, such a big base it is coming out, right? Where is the price now? From the peak, it was at 300. You are getting at 168. So around 45% discount I'm getting from the peak. Okay. Price wise, I am sitting at a 40%, 45% discount. Let's look at the fundamentals. Guys, this will be my last example because I am touching the deadline. Yeah. So here what you observe, now here I'll show you the magic. So you are at a 48% discount from the peak in terms of price. But my dear friend, this is the best ever quarter you had. This is the best ever quarter you had in terms of your earnings. You're running at a very good quarters. You can see it is the bit less than the 2021. Okay. But otherwise, this is a very good quarter that you have had. And earnings wise, you can see this is the best. This is the best EPS quarter you had. So either of these things, you look at it, this is very best. Margins are superb in this business, highly monopolistic. This business is just going to keep on growing on volume. You know, the on the quarterly, it is cyclical. On quarterly, it might be cyclical because weather-wise, the power demand goes up and down. But annually, if you see, this is the quarter where this is the year where you are getting a very good profit growth. So when was your peak? If you look at your peak, when was the peak on the chart for the IEX? Yeah. So the peak was in January 2022. So compared to January 2022, that would be your result over here. Here. So compared to that year, you are way up above. Can you see there's a big jump from 317 you have come to 420, from 259 you have come to 350. So your jump here is around 40% jump in the earnings is there, but price is at a 48% discount. You got a disparity. Your growth is there, but the price has corrected. So what happens to the P by E? That is also corrected. So you get something which is again creating a disparity. You're sitting on a good opportunity over here. Okay. Product is unique, monopolistic. So they are a leader, right? Another case which came out 2-3 weeks ago, which I shared on my Twitter handle, IRCTC. Same thing, monopolistic business. Monopolistic business, my dear friend Mark Minervini giving me a good structure over here. Okay. So it came out of the shelf, right? And what is the business all about? So railways are growing, tourism, travel, everything is growing. Then what will happen to IRCTC? Till the time government privatizes and brings in some other catering partner, these guys are having a monopoly, and that can be seen. You know, you can see over here, your earnings are at the best. Your earnings are at the best. Your margins are at pretty much a good high. They are good here, but overall earnings are at high. And you can see the best of the best earnings you are having. So your earnings are best. Your earnings are best ever, while the stock is available at a correction. So how much is the correction? So if you see the peak of 1250 to 750, so this is again a correction of around 30 to 40%. Yeah, 30 to 40% correction you are having in price, while performance wise, If you look at the peak of IRCTC was in November 21. So from November 21, if you come over here, that was the September results that you had. See, you are more than doubled. You are more than doubled in your sales, and more than around 70-75% you are grown in your earnings. So your earnings have grown 70%, price has corrected 40%, net your PE has become comfortable below average 5 years. So you have a CanSlim, you have a unique business, you have a leadership business over there in a sector which is hot, market is in uptrend, and price is at a nice 30 WMA. So these are the combinations which actually help you. So I'll stop over here, guys. My time is up over here, and for any further things and all that, I encourage you to get in touch with me on Twitter, Milind for Profits. Definitely, I'm open for any other opportunities to connect with you guys on this platform also. But otherwise, also you can reach out to me over here. And the last thought with which I would like to leave you is that there will be times while you work with all these strategies and all the things which seems you are doing right, but you would meet failure on the way. Okay. So if you meet failures on the way, read this quote again by the Guru William O'Neill. If you get discouraged at times, don't ever give up. Go back and put in some detailed extra effort. It's always the study and learning time that you put in after 9 to 5, Monday through Friday, that ultimately makes the difference between winning and reaching your goals. Focus on your goal. That goal is really beautiful. That goal is really beautiful. It is worth achieving, because once you'll achieve financial freedom, you'll be able to work at the place of your choice, with the people of your choice, with the initiative of your choice, can do wonderful things for your family. Let that goal motivate you. There will be stopovers, there will be kind of a bit of setbacks, but never we are going to fail. Just keep refining your strategies, go through these books, you will come on track. And always, I am there. We can always partner along and grow together, because yeah, that is what is satisfying me nowadays. That is what my ikigai is, right? To grow people. And missing out on a truly great opportunities that really can change your whole life. So don't miss out on this opportunity. Go through these books, refine your strategies, stumble, be humble, correct your ways, and grow. With that, yeah, always great to connect with you. Thank you for today's opportunity. Also, you can reach out at me at Milind for Profits. And last but not the least, the next year is up here, just on the other side of tomorrow. Wishing you all a great 2024. I'm sure your books will be much better in shape while you take your profits in the next year. For the next year, we have run up a lot, right? So around March, April, I see a bit of correction, and again the stock setting up well around June, July, when the elections and other things stabilize. But yeah, don't lose the AI story with Mafang. That will continue to happen in US. That's my parting message. Thank you again, guys, for so much of patience, and I hope I could keep it interesting for you, not dragging along and forcing you to, keep itching and keep your eyes open. Thank you very much.
Definitely, sir. It was our great honor to have your presence and your lessons being taught to us in the practical aspects. Like, it really made CA from CA, that is chart analyst, from being chartered accountants. Last but the most important, this webinar was organized by Committee on Financial Markets and Investor Protection. Though today we had not the presence of CA Charanjot Singh Nanda, sir, who is the chairman of CM committee, and CA Kotha Srinivas, sir, who is the vice chairman of CA committee. But this webinar was not at all possible without the team effort of Committee on Financial Markets and Investor Protection, ICAI. Charanjot Singh Nanda sir does not need any introduction. He had been the chairperson to many of the branches, and he had been currently the chairman of Committee Financial Markets and Investor Protection. And not only this, he is a motivational speaker and has conducted many seminars and many webinars along with students, promoting them to attain their financial literacy, and not only that, but the aim of the life. Thank you, sir. It was our blessed time to have your presence. Last but not the least, I would like to summarize the books that were recommended by you, or not only the books, but the gurus that you have given to us for attaining the financial freedom. The first one being Secret Profiteering in Bull and Bear Market by Stan Winston. The second one being The Moving Averages. Yes, Secret from Profiteering in Bull and Bear Market by Stan Vincent. The second one being The Moving Averages by Steve and Holly Barron. The third one being Trade Like a Stock Market Wizard by Mark Minervini. The fourth one being How to Make Money in Stock Market by William J. O'Neill.
Yes.
So, which one is the first book that you would recommend to start with?
Yeah, this book actually going in that same sequence will be a good thing. Start definitely with the Stan Winstein. Read just 160 pages. First 160 pages, good enough. Then you move on to Steve Burns' book. Read it full. I already told you it is thin book. Will not test your patience. Then third book that you should read is by Mark Minervini. If you don't have time, just read the chapter number 10. A picture is worth $1,000,000, and seriously it is. So look at the chapter number 10, and the book by William O'Neill, look from 111th page till 200. So I made it small and sweet for you.
Definitely, sir. Definitely. I think our readers and will get enriched by the knowledge that you shared of the books. The viewers will definitely be referring to the books that you have suggested. Last but the most important, I would like to take some queries if you permit.
Yeah, all for it.
There is one query from Shivansu Mugum N, that is there any key takeaways that you would recommend apart from the market books, like what you have learned in your financial journey of being financially independent?
I think have a more richer goal in your life. Till the time you are spiritually involved to achieve something big, a bigger picture will always draw you up, and the universal forces will always be with you. The power will be with you till your intentions are good. That's far ahead of market, but that works.
Definitely, sir. If you are trying to start from day zero, how much time would you take to become the master of this field? Or what are the recommendations that you would give to our viewers for today so that they can plan accordingly to achieve the financial literacy?
See, there are different ways you can go on your own through the books. It might take a bit longer, or you can find out somebody who has done it and who has been doing it pretty well. Observe them, observe how they are doing their studies, learn from there, or get in touch with a mentor or a coach, and you can take it from there. You can also make a study group within you to exchange the ideas. But challenges are that when it comes to money, people make walls pretty soon. So you'll have to really be very selective about it, but that is the route. Either do it self through books or through a selected circle of competence within your team. And thirdly, try to figure out somebody who is ready to work with you and who is succeeding in the market. Yeah.
So to summarize, we would like to have your journey, that how you took out from mechanical engineering and working with the Tata Group, and then again starting with the new journey of finance.
I think COVID happened for me, which was good because I'm very much a people's person. So in my last role that I had with Medline Industries Pune, I was actually working on the HR team. So you can see I've turned around a lot from mechanical to software to HR roles. And being on HR roles, I was very much in habit of being touch in people on the live mode. So the moment COVID forced me to go behind the screen, I was uncomfortable. Fortunately, COVID brought me to Twitter and I started sharing ideas and people started liking it. So that's where I tell you, now, many times you'll be surprised in your life. Your intentions are great, no? The power start falling in line with you. And somewhere, what I wanted to do at the age of 48, it just happened with me. So yeah, the long-term plans, they work for you. Keep your intentions good. That is what I say. Yeah.
There is one question from Sumit Jain as well as Raj Gopal sir from Bangalore and Jaipur respectively. In IEX, you were comparing 2020 figures rather than 2022, and how do you think that IEX going to perform? because of some control by government?
There is definitely, that is where I tell you, don't use your lot of brain when it is happening on the chart. Definitely something is cooking. So we are trailing it. If it hits our stop loss, will come out. That is what I say. Overthinking will keep you away. So I definitely, one thing I know, IEX is very much monopolistic. The earnings are showing an uptrend. Earnings are showing me steady growth. And yes, it was PE wise very high. It became valuation wise comfort, and now somebody has made a structure over here and he has been investing for more than 2 years. The chart structure tells you that base is being done for 2 years. So definitely something is there. So sometime you just trust the chart, look at the numbers and enter and then trade it. Things will not be clear right on the first day unless you're an insider.
Definitely. We have one query left from Sumit Jansar from Jaipur. What would be your views on capital goods and infrastructure sector, sir?
Well, they are running good. They will continue to run good is my thought process. Ace, if you look at Ace, you look at Brady. The Brady is another small company in microcap. They are all into cranes and all that. So if you're not able to spot any particular contractor who is getting the road contract or the flyover contracts and all that or the railway contracts, fall on these players because these are definitely going to supply stuff to all these anybody who gets into this construction business. So another way, good way is that definitely try to play with a secondary level player. Order can go to anybody, but this guy will benefit. So this sector is going to do good. Kirloskar Industries, by the way, another stock which came out of 30 WMA with excellent CanSlim kind of a setup today. So capital goods thing, yeah.
Sir, 2023 has been ending. Just one day left of 2023, and 2024 is going to come. What is your recommendations for investment of any person who is sitting on a small capital, who is sitting on a large capital, and as well as middle capital companies? What is your recommended sector to 2024?
I would really go ahead with green energy because green energy will continue to matter for this world and will continue to keep on gaining strength at least 2 3 years. And defense because India wants to export things, so they will encourage defense stuff because our your trade balance and all that is really important for us to India the way it is growing. So these are the two sectors that you can continue to look. There's a turnaround happening in chemicals, but I am not somebody who is an insider who knows why it is happening. Charts are looking good. You can take some positions over there. Of course, CanSlim is not working there because earnings and growth are still yet to happen there. So maybe next quarter results will give me that clarity. From there, I'll become more confident. But these are the stuff. And PSU banks again looking solid. And as per your capital, please try to make sure that you expose yourself in a safe manner. As I told you, trail the donkey, but don't come too close to it. If it kicks you, it hurts like anything. Stay at a distance, trail it well with your capital, and stay safe. And definitely, seasons change here. It will go down, you will exit, it will come up, you will enter, you make money. Till the time you walk with your friend only the way up, you make money in the market.
So there is a positive perception of Indian market that you are going to see in 2024.
Yeah, yeah. Since my birth, I'm positive on India. I don't know the economics.
Definitely, sir.
Yeah.
And what is your outlook as retail investor that you expect from budget? Like, are you bullish on real estate sector or energy sector that will come after the expectations of budget?
Actually, the RBI rates are going to get lowered, and that is where the real estate is already run up, if you look at it. So many things in real estate are already running up because they know the rates are going to cool down, and from there the housing rent and other things, the loans are going to get cheaper. So real estate is definitely looking positive, and yeah, bankings and infrastructure is also going to go good.
With this key takeaways, I would like to recommend my viewers to just go through the books that sir has suggested. And believe me, it's not just the books, It's the gurus that sir have given to us, the gurus of life, the gurus of investment mantra. It's the lessons that sir has himself learned and made us learn by giving his precious time. Thank you so much, sir, for your most valuable time.
It was all my pleasure. Love to share the ideas. Love to see the receptivity from you guys. Make big money in the market, guys. The success is
Definitely,
waiting for you.
definitely. So your guidance will always be ensured in this.
Most welcome.
Thank you so much, sir. With these words, we would like to end. I, on behalf of Committee of Financial Market and Investors Protection, ICAI, would like to once again extend my thankfulness for investing your time and for expecting us for with good, happy New Year, sir.
Happy New Year, everybody.
Thank you, sir.